for investment? How do you see that? Maybe Dina, go first, and then...
You know, I'm bullish. I'm bullish because I've, over the last several years, worked on these issues, been in the region. I see the genuineness of the desire to move forward on the social, economic, and political reforms, although imperfectly, and certainly with some steps taken back. And frankly, it's in the U.S. national security interest that those reforms are completed, and for our allies as well. And so I think it's like a genie out of a bottle. I think once you get moving in that direction, it's hard to go back. And I actually think that it is very likely that, and we know this, that the Saudis and Israelis were very close to normalization. And in some ways, you know, there's a saying, don't waste a good crisis, and this horrific tragedy and crisis could actually be the final straw in those, in between those two, you know, axis of resilience and axis of resistance. And
you can watch the rest of this panel and all of our coverage on the Qatar Economic Forum on the Bloomberg terminal at Live Go. That conversation, Bramo, actually pretty interesting. Monetary policy, unchanged for the rest of the year, seemed to be the consensus view on that stage.
Given the fact that inflation is so strong, and Dina saying that this is actually going to be the #1 issue that's going to really affect the election.
We'll continue this conversation in the second hour of Bloomberg Surveillance. Coming up next, Evan Brown of UBS, the former House Speaker Kevin McCarthy, David Livingston of Citi, and Ian Lingen of BMO. From New York, inflation data and retail sales just around the corner.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
market can do very well with the Fed on hold. So the good nominal growth environment has been supportive.
I don't see the stagnant. I don't see the inflation. We're still growing. We're still growing at 1.5%, 2%.
We're just still running too hot for the Fed to comfortably cut rates significantly with the economic data as strong as it is.
That the Fed will cut later this year. The path to normalize rates and normalized inflation is going to be longer than the market perceives.
We're still in the pivot party, I would say, and Chair Powell's been the lead bartender on this.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
And he was serving drinks yesterday. Live from New York City this morning. Good morning, good morning. 90 minutes away from inflation data in America. 8:30 Eastern time looks a little something like this. You get US CPI, then retail sales, then 3 Fed speakers follow up. Look out for Kashkari and Bowman. Quite hawkish at the hawkish end of the spectrum over on the FOMC. The estimates this morning, Lisa, headline, month over month, 0.4. Core, stripping out food and energy, 0.3.
Which would be the lowest reading of the year, which is the reason why people are prepared to really lean into this pivot party. You said that he was serving drinks yesterday. Was he? He's trying not to, but everything that he does, it's sort of, here, you get seltzer today, and they say, no, we don't. This is actually spiked. It's hard seltzer, and that seems to be kind of the disconnect that we hear.
The bias hasn't shifted. The bias is to cut interest rates, and I think the base case for them hasn't changed. The probability around that base case might have shifted. They talk about their loss of confidence over the last few months, but ultimately they still believe they're going to cut later this year.
This is what Powell was talking about yesterday. He says all of those things lead us to believe at this time that policy is restrictive, and it looks like it'll just take longer. We will get there, but it'll take longer. But if we're looking on a month-over-month 0.4% higher, that brings CPI year over year at 3.4%. How many good data points do they need to get closer to even 3%? Not even on the 2 handle that he's looking for.
But you raise this great point. Is it enough just to say we're not going to hike anymore? Is that really enough? Is that to keep this going, given the fact that, okay, we've gotten that, they're not going to hike. Okay, it's higher for longer. If they really don't cut rates at all this year, does that really have no effect on equities whatsoever? That seems to be one of the themes that we hear from everyone.
I asked a version of that question in the last hour with George, and I think it's the right one. Are we reaching limits of that? How much comfort can you take from data moving in the wrong direction just because you believe the Fed's not going to hike? What about that phrase we've been talking about to credit investors, survive until 2025? Do you get to a point where interest rates are pushed so far off into the horizon that it actually becomes a problem? And bad news really is bad news.
And this is the reason why you do have some people who still are kind of beating the bearish drum and saying it's all going to fall apart, and and it might fall apart later than we had previously expected. And then other people say, actually, no. This is it. This is the new normal. We can chug along at these rates and just move forward. This is the divide between people who both want to rally in the bond market and a rally in the equity market at the same time.
That data is just around a corner, and equities and bonds have been rallying at the same time recently. Equity futures at the moment, the scores look like this, just about positive on the S&P 500. In the bond market, yields lower by 2 basis points, 441.98 on a US 10-year. Coming up this hour, we'll catch up with Evan Brown of UBS with stocks near all-time highs. We'll speak to the former House Speaker Kevin McCarthy on the 24 election race, and BMO's Ian Lingen on what the CPI print could mean for markets. We begin with our top story. Equities nearing all-time highs ahead of US CPI data. Evan Brown of UBS writing this: our risk-on positioning has been informed by a simple premise. If central banks are cutting rates into an environment of already healthy backdrop for nominal growth, that would be a uniquely positive backdrop for stocks. Evan joins us around the table. Evan, good morning.
Good morning, John.
Do we have a uniquely positive backdrop for stocks?
Yeah, I still think so. I mean, maybe we've pushed out the timing of rate cuts a bit, but the fact is we're in a healthy nominal GDP environment, right? We're talking about 5 to 6% nominal GDP this year. In the prior cycle, we were under 4% on average, and that's a good environment for earnings, and we just saw that this earnings season, best one since 2021.
How big is that window? Lisa talked about the new normal, maybe even the old normal, going back to where we used to be 20 years or so ago. What is the new equilibrium, if we can call it that?
What's the new equilibrium? So I think where we are now is essentially the new equilibrium. I don't think we're getting back to 2% or below 2% inflation on a sustainable basis. I think we'll be somewhat above. 2% was more the ceiling of the last cycle, and it's going to be probably more of the floor this cycle, but that's not such a bad thing. I mean, I know that the Fed is talking about we have to get back to 2%, but I think there's a little wiggle room there. I think, when it comes down to it, if they say, that those last few tenths of a % are worth destroying the labor market, they will hold off on that. And they're going to be very sensitive. If we start to see the labor market crack, they'll be sensitive even if we're not quite at that 2% level.
A lot of people have been very surprised about the strength in the economy, about the strength in equities, the strength in profits. And a lot of this has really stemmed from the great fiscal transfer, that we have incredible amounts of government money funneled not just to consumers, but also to businesses that hasn't even been distributed yet. How much do you bank on the fiscal impulse overwhelming any monetary impulse for the foreseeable future? Is that essentially the bet on equities right now?
I don't think it's all fiscal. I mean, certainly it has helped the economy, and it certainly helped the economy at coming out of COVID to get those big fiscal numbers. But I think people overstate the fiscal and understate the this is an income-driven cycle. Real incomes have been improving significantly as inflation has come down. Nominal incomes have been remarkably steady, again, growing over 5%. And so if that's the case, right, if people, wages are in decent shape, if employment growth is in decent shape, hours worked in decent shape, then they'll be okay, even as some of those excess savings are dwindling.
If the way that you portray it is the way that it plays out, which is sort of not early cycle, but more mid-cycle than certainly late cycle, why not get all into small caps? Why not say, you know what, it's going to start broadening out, and we've already seen the beginnings of something that is sustainable and based on fundamentals?
You need to start seeing rate cuts to get small caps going, because the small caps really depend on much more on financing than some of these like cash-rich large cap companies, and so their margins, the longer that we have if we have rates higher for longer, that is going a steady bleed in their margins, and so if that's the case, then to really get that small cap rebound, similar to what we saw in Q4. You really need the start of a rate cutting cycle, and it's not here just yet.
It's the rotation everyone's been itching to make for the last 4 or 5 months. In fact, I'd go back even longer than that, but we'll save that. I want to congratulate you for a call that you made in the last year or so. There has been a big spread between manufacturing and services, and a question we've asked around this table for a while is how we'd close that spread from either direction. How would we converge? And you said manufacturing would come up to services. That started to happen over the last few months. Can you talk to us about another spread that we see, and it's between the US, the perceived spread between the US and the rest of the world? How do you think that's going to converge in the years to come?
Yeah, so I think it will converge. I'm not looking for the US to fall off a cliff or anything. It's more about the rest of the world picking up, and it's related to that manufacturing versus services call, that just most of the rest of the world is more export driven, more manufacturing driven than the US. But I mean, we want to be early to trends, and if you look at your Bloomberg machine and you look at all the growth revisions this year, and they've just skyrocketed for the US, and then you see Europe and China kind of hanging out, Japan on the low end, but you're starting to see a little life there in those growth revisions. Economists in Europe are starting to revise up growth because inflation has come down in Europe, and that is finally getting the European consumer a little bit more confident about spending. And so, I think the combination of this improvement in manufacturing, which is linked to inflation really coming down faster in some of these countries than in the US, and so that helps the domestic consumer. That also helps manufacturing and exports.
That has implications, of course, for markets, equities, rate differentials, and implications for FX. Where does that leave the dollar?
Yeah, so dollar, I think we've got room here for a little bit of weakness in the near term as you get this global rebalancing, but I wouldn't extrapolate that too far for 2 reasons. One is that structurally there's still this very big disconnect in terms of how sensitive the consumers and businesses are to higher rates in the U.S. versus the rest of the world. We've got our 30-year fixed mortgage, and most other countries are dealing with the variable rate. Rate cuts outside of the U.S. are going to help a little bit with that, but that's still a constraint. But that's the first reason. The second reason is, look, we got a 50% chance of a Trump presidency, maybe more. And people aren't talking about it as much now, but a few months from now, we are going to be talking about 10% tariffs on all U.S. imports. We're going to be talking about 60% tariffs on all Chinese imports from China. And there's going to have to be some risk premium put in basically every other country outside of the U.S. to reflect that tariff risk.
Why is it a risk premium on the other countries and not on the United States of becoming increasingly isolated?
Well, I think it's part of this kind of like natural global rebalancing when you have tariffs, or we would need in the U.S. if Trump is going to put on the kind of tariffs that he's talking about, we need a stronger dollar to make sure that inflation doesn't get out of control. The dollar needs to offset that to bring inflation down here. So I would expect the tariffs to be a headwind for the U.S. as well. But there's two sides of the same coin here, where it's weakening the rest of the world, but also we need that stronger dollar to contain inflation here.
We'll speak to a man with opinion on that in just a moment. We'll catch up with Speaker McCarthy in about 5 minutes' time. Evan, great to see you in person. It's good to see you, buddy. Thank you. Evan Brown there of UBS. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Primary elections were held yesterday in Maryland, West Virginia, and Nebraska. One race in particular could determine control of the Senate in November. That is Maryland, where Angela Brooks defeated one of the richest members of Congress, David Trone, in the state's Democratic Senate primary. She will be facing the Republican government, Larry Hogan, in November. It's expected to be a competitive race that could tip the balance of power in the Senate. Copper is rallying to a new record high in New York, up some 24% over the past year, driven by a short squeeze. Futures surpassed a previous record that were reached in March 2022. Traders have snapped up call options on the COMEX, with the premium widening on demand for upside protection against a further rally. A group of TikTok creators have filed a suit to block the law forcing parent company ByteDance to divest or face a ban. A lawyer for the creators said, quote, they hope to vindicate not only their First Amendment rights, but the rights of the other approximately 170 million Americans who also use TikTok. A spokesperson for the Justice Department said the government looks forward to defending the law in court. That's your Bloomberg Brief. John.
Danny, thank you. Much more from Danny in about 30 minutes' time. Up next on the program, the U.S. ramping up tensions with China.
For years, the Chinese government has poured state money into Chinese companies across a whole range of industries. When you make tactics like these, you're not competing. It's not competition, it's cheating.
We'll catch up with Kevin McCarthy on the other side of this break, live from New York. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
live from New York. Welcome to the program. 1 hour, 15 minutes away from that all-important economic data. That's just around the corner. Equity futures going into that on the S&P 500. Just about unchanged. Trading water here, positive by almost 0.1%. Your 10-year this morning, 441.20. Yields are lower by 2 or 3 basis points. Under surveillance this morning, the US ramping up tensions with China.
For years, the Chinese government has poured state money into Chinese companies across a whole range of industries: steel and aluminum, semiconductors, electric vehicles, solar panels. The industries of the future. China heavily subsidized all these products, pushing Chinese companies to produce far more than the rest of the world can absorb. When you make tactics like these, you're not competing. It's not competition, it's cheating.
So here's the latest. President Biden unveiling a sweeping new round of tariffs on Chinese imports ahead of the November election. The decision looks to escalate measures first put in place by former President Donald Trump. The former House Speaker Kevin McCarthy joins us now. Speaker McCarthy, good to see you.
Good to see you.
Great to catch up, sir. What did you think of that from President Biden? Did Biden just out-Trump Trump?
No, he can't do that. I mean, Biden opposed these tariffs before. And I actually believe when it was only Nixon can go to China, I think a Republican administration always has a better relationship with China and a stronger one. We've watched in this current administration, they've created like an axis of evil with Russia, Iran, and China, something we haven't seen since the 1930s. And there's an interesting piece by Henry Kissinger before he passed and Graham Allison, 79, 79, and 9. 79 years since a Great War. 79 years since a nuclear weapon was used, and only 9 countries with the potential of a nuclear, which in the 70s you thought there would be 25 or 30. That doesn't just happen. So foreign policy really matters. The world is in a different place. They're looking for a strong kind of American Western leadership, and I think that's the challenges that we have. And Biden's decision in Afghanistan and what he's just doing with Israel, it's really harming the world, let alone America. And I think greater stability will go a long way.
When it comes to China, though, Biden and Trump are largely on the same path. Trump is talking about 60% tariffs on imports coming from China on top of potentially a 10% tariff wall for all imports. Isn't that trajectory, isn't that the only place, you know this well, that there's bipartisanship in Washington when it comes to China?
Well, you want to look at it. Trump's policies on China, he believed long before he was ever elected. Biden has flipped his position on China in the last year. So it's kind of what you believe. And I think in China's position, China always looks long term. So if they have somebody in there with a strong position, you usually can negotiate something there. I believe, and I think looking at the New York Times latest polling, Trump, election is today, Trump would win, and probably pretty big. Republicans would have a very big night. That you would have an agreement with China. You might think there's a little tension, you'll get a lot of good news for a while, but I think we would be in a much stronger place because there'd be greater respect on each side, and that's where you could come to an agreement.
But an agreement on what?
I think you could get a lot of places on agreement on trade, agreement on the movement of China and Russia and Iran. I think China moving into the Middle East, bringing Iran and Saudi Arabia together, you wouldn't see that as much anymore. I think America would take back the place that they've stood before.
So you were with the former president last night, according to photos I saw online. What are you hearing from him and his team about what 2.0 would look like? Would that also maybe include someone like yourself?
Look, you never prejudge where it is, but I think the president, he's very upbeat. You look at what he's going through. Interesting thing. I think the White House has taken a position, and almost every position they're taking is all political, like this China position, Israel position, what he's looking at. And I mean, if you look at Biden in the last elections, and you're a station that plays with numbers, Biden won the last election by 48,918 votes. But his favorability rating at that time was +10. Now it's -20. You've got 6 states that are swing states, and Trump has been leading in 5 of them for like 14 months. And now Minnesota, which a Republican has not won since 1972. When Ronald Reagan swept 49 states, he didn't win Minnesota, but now it's a tie within Minnesota. So it's a much different play going forward. And I think their position, they thought going after Trump in a judicial way would help them. I think it's hurt them. You also see independents now. I mean, by a margin of 53 to 42, independents believe another 4 years of Biden will harm democracy. And they say democracy is on the ballot. So it's interesting what they have planned out. And my advice to the Biden administration, if you're in denial, you're not going to solve your problems. And they're kind of in denial of the problems they have.
Can I just ask you a follow-up, though? You didn't answer my question. Would you consider going into a Trump administration?
Look, I would consider to serve anywhere if I'm the best person to. I think in America, we need the best and brightest. But I think that's the last thing you look at. You want to lay out, make sure it's good policies. You want an election to be about policies and ideas. Then people can govern in a better way.
I want to try to strip away some of the politics from the policy and try to understand looking forward. You talk about, under a Trump administration, this idea of some agreement with China. I'm more focused on Europe, frankly, because under a Trump administration, it was America go it alone, America first, going out of NATO, really pressuring the European Union to do more. How much is that going to be basically the state of play going forward in the Republican administration at a time where a lot of people are saying you need an alliance to really counter some of these threats that you're talking about?
That's a great question. And we should look, because now we have time to compare what transpired in the Trump administration and what happened now. Was Trump tough with NATO? Yeah, but now you're watching the European nations actually spend more what they had promised to do on their defense, which they haven't. But let me answer your question, okay? Now what you didn't have war in Europe. For the first time in any American administration in modern history, Putin had not invaded another country. Now we have war in Europe. But let me finish your answer to your question. You have 5 American embassies that have now had to be evacuated. We now have a base in Africa where the Russians are now coming into, where you have 1,000 U.S. troops leaving out. It's the place we use our drones and others. So I know what the topic is and maybe the brushness of Trump's message, but we actually had positive returns within there. So it's a difference of opinion, whether you like the headlines or not, but you really have actual facts on the basis of what a Biden administration looks like in Europe and what a Trump administration looks like.
Although there are long and variable lags with a lot of policies, so it's hard to identify exactly where some of the gains come from depending on who comes out.
Well, you had the Abraham Accords, which I believe people should have got a Nobel Peace Prize over, but had Biden embraced the Abraham Accords, I don't think you would have had October 7th.
But my question was with Europe, and particularly on the commercial side of things, because what we hear from a lot of executives is they don't know how to even shape policy, given they don't understand what the policy in the U.S. is going to be to European goods. Are they going to start to put up walls to those too to try to really enhance the industrial production of the United States? Are they going to work together? Is there going to be cohesiveness at a time where France seems to open to the idea of accepting electric vehicles from China? How does a Trump administration deal with issues, given the fact that a lot of people say we need these alliances in order to actually win on some of these issues?
Well, I think we have strong alliances. I remember in the Trump administration, I was there with Macron in the White House. I mean, look, every country is going to want to compete with one another. I think what America wants to see is a level playing field. It's a disadvantage if America starts further behind. And France, they want to have a level playing field, but every country is going to compete in different ways. And I just believe that at the end of the day, you will find the policies we had under the Trump administration, the policies we have today, America didn't have inflation. We were stronger around the world. Incomes were rising. And what you're finding in the New York Times polls, America sees that too. And I think the #1 issue people are going to drive is going to be inflation, the border, are they going to be the 2 largest drivers of this election.
You don't think that birth control and abortion are going to be a big factor as well?
I do think it'll be, but it'll be in certain spots. It was a big factor in the last election. But remember this. I mean, you also look to what's going to happen in the Senate and what's going to happen in the House. I was leader for 5 years, and every single cycle, when I was leader, Republicans picked up seats, even though Republicans lost everywhere else. When Biden was on the ticket, it was the first time since 1994, not one Republican in the House lost. In the last election, abortion was a very big issue. But as leader, I picked up 5 seats in New York and 5 seats in California. You would say abortion would be the top issues there. So I believe in pockets. Arizona could be an issue. Florida could be an issue. But I think it'll be more in a pocket than it will be national.
You talk about your leadership. Speaker Johnson had 11 Republicans vote to oust him. You only had 8. Democrats came to save him. Are the Democrats in charge of the House at this point?
Hakeem thinks so. I mean, he says it on 60 Minutes.
They saved Speaker Johnson.
Look,
He actually had more Republicans vote against him than you did, but you lost your job.
That's not right, huh? Look, I don't believe in the motion to vacate. I think Democrats play politics on both sides. If they didn't think the motion to vacate was right then, why did they think it under me? So, but it is what it is. It's politics. They think they're going to play it for a political purpose to win. Republicans have a better chance on winning seats this election in the House than they did in the last 2 elections we won. So I think it's going to be a big night. You watch what happened in the primaries last night in Maryland. Hogan is going to make Maryland competitive. And what that does, it expands the playing field. The Republicans are going to win the Senate. It's a simple math question. The presidential election, it's still up in the air, but you look at every polling today, Trump is in the lead, and Biden's doing nothing to change that. In the House, there's a better opportunity for Republicans. The only challenge and advantage the Democrats have is they're beating us now on money rather largely, and that will make a difference.
I've got about 10 seconds left. Can you give us a name for VP? What do you think? Who would you like to see in that seat?
Look, there's some great people, and
10 seconds.
I sat with like 10.
It's a name.
Look, I think Tim Scott is great. I think our governor in North Dakota is excellent.
Nikki Haley?
Look, if he picked Nikki Haley, I would say the race is over.
Yeah, I think
the race is over.
That's the entire party.
If you look at the primaries, even in Indiana,
10. I've only got
20%.
10 left to the break now, Kevin. We've got to go. Speaker McCarthy, thank you, sir.
Thank you.
Let's do it again soon.
All right.
From New York City, this is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow.
And these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from a ton of economic data here in America, 8:30 Eastern Time, US CPI and retail sales. The scores going into it, equity futures just about positive, just about. We're positive by 0.04%. The Nasdaq going absolutely nowhere. This market's been going somewhere, and that's back towards all-time highs. Just a whisker away. We'll be talking about them, no doubt, as we get closer and closer to the opening bell at 9:30 Eastern. If we switch up the board and get to the bond market, we've been talking about these levels for a while now. The last time we got CPI data, mid-April, 4.97 was the closing yield on a US 2-year. We were higher on the session that day by more than 20 basis points. We breached 5%. We came all the way back down to the 470s. Lisa, we're down this morning by 2 to 478.92.
With the 10-year at 440, about where it was before we got that CPI print on April 10th. Again, how much are we set up for a rally, and how much have we baked in the good news of potentially the softest CPI print of the year at a time when everyone's been waiting for disinflation in this Godot-like moment, and it just hasn't come to the degree people have looked for?
Let's turn to foreign exchange just briefly. I'll get you the scores in the FX market. The euro looks like this against the dollar. €1 at the moment, about 108.26. We're positive by 0.06%. That is a slightly stronger euro in today's foreign exchange market. Under surveillance this morning, a key data drop a little under an hour away. CPI and retail sales due at 8:30 Eastern Time. Bloomberg Economics expected the CPI print to show that disinflation has resumed, forecasting core CPI to come in at the lowest mark this year. Elsewhere, a short squeeze driving copper futures to a record high in New York. The premium on copper traded on the New York exchange compared with other global commodity exchanges is prompting a rush by traders to divert the metal to US shores. And finally, more trouble for Boeing, the company facing possible criminal prosecution after the Justice Department found it violated an agreement tied to 2 deadly crashes 5 years ago. The DOJ found Boeing breached a $2.5 billion settlement by, quote, failing to design, implement and enforce a compliance in preventing and detecting violations. Lisa, that stock is down another 1% this morning.
Come on. We have asked for this before. Can we stop getting news from them that indicates that things are just getting worse? The answer is no. And here's the issue. At what point can they put a stopper on this at a time where people are saying, well, are we going to have a shortage of planes given all of the orders that really aren't coming through?
Also, how important Boeing is to the industrial base in the United States. They have 4 weeks to respond now, but what can the Justice Department actually do? How do you punish a company that is so critical to the United States? And not just people getting on planes, but the defense sector.
It's a total mess, let's put it that way. Boeing's a little bit lower again in the pre-market. Let's turn to the IPO market, where listings are poised to slow following 5 straight weeks of more than $1 billion being raised. David Livingston is the Citi Chief Client Officer, and David joins us now for more. David, good morning to you.
Morning, John. How are you?
It's good to see you. I'm fantastic. Let's talk about where the action is at the moment. We've been saying around this table for a while that maybe the investment banking recession is over, behind us. We want to talk about where things are picking up. The IPO market, how strong is the pipeline for this year?
It's building, it's solid, but the conditions that you want to talk about and that investors are looking at as well as issuers are looking at in terms of rate outlook, and not so much the absolute, but particularly the volatility in the rate outlook. We're sitting here with some of the biggest spread in terms of potential outlook for year-end rates in dollars that we've seen in a while. The issuers are going to sort of are looking at that and saying, well, how does that impact not just equity markets, but also investor appetite to be investing in IPOs right now? You're right, we've seen a very strong last few weeks, particularly in the United States, particularly in the healthcare sector. We expect those conditions to continue, but a broader rally and deepening of the markets, I think, relies on some of those other factors.
Has there been a structural shift because of what's developing in private markets that's maybe holding back companies, and basically they've decided they don't need to go public in quite the same way they perhaps needed to decades ago?
I think there has been a shift over decades, and the growth of private markets, not just here in the United States, but around the world, give alternative capital formation opportunities. And you've seen, I think the US is the standout in terms of the public market still being deep, liquid, accepting, very strong following in sectors with multiple comparables. You go elsewhere around the world, UK, for example, very challenging in terms of the number of companies either leaving exchanges, moving to the United States or not coming to market, and with IPO levels being very significantly down.
Speaking of which, I have to go there. Zeekr came to market in the U.S., in New York, which is basically an offset of Geely, right? This electric vehicle maker in China did really well. And it just raises larger question of, do you still see the same degree of cross-border IPOs of companies, not just in China, but other places coming to New York? How much are people concerned about some of the geopolitics behind it versus, hey, a lot of people have money, let's go?
I think it's not just that a lot of people have money, but it's also just the depth and quality of the U.S. capital markets. I mean, it is gapping and it is significantly ahead of the rest of the world. If you go around, I've mentioned the UK, but also the European markets are not as deep as they need to be. Asian markets the same. So I think it's that just continued attraction of the quality of the equity capital markets here in the U.S.
Is there a rival at this point? We
No.
were hearing a lot from Paris. You buying that? John talking to David Solomon, Brian Moynihan, talking about building out in Paris. It's looking better and better from every point of view.
It was Macron doing the selling. Let's be clear about
And they were doing the buying. So
Sure.
are you doing the buying too?
Look, particularly in Europe, I'll say that Europe is the place that has to do the most structural change post-Brexit. Because they need to build capital markets. And as you know, they've been trying to build capital markets and banking union for many, many years now. And what you're seeing, I think, in France, in the Netherlands, to a certain extent in Germany, is member states realizing that they need to deepen their independent capital markets before there can be an EU layer created. There is too many impediments. And so what President Macron is talking about is absolutely sensible. And yes, Paris will grow, the markets will deepen, but I don't think, as to your question, will be a competitor to the United States.
What does that mean for your regional footprint as Citi? Where do you want to be located? Where do you want to boost staff, pull back on staff, given those forces that we've just discussed?
Well, we follow clients, and so we're talking about an IPO market. It's obviously a very narrow bit of what we do. So our network remains, we operate in over 160 countries around the world, and we continue to see broad, opportunity in all of those regions that we operate in. So no dilution. Of course, there'll be at different times, different areas of more positive growth. Again, I come back to the US being, with the characteristics of not just economic, but innovation and some of the stimulus that's happening here. Europe, cautious, but many European clients see that as an opportunity to take their own business models outside of Europe.
Do you think the US policymakers risk undermining the exceptionalism that we talk about every day on programs like this with some of the decisions that they're making? And I'm thinking more broadly, perhaps more narrowly actually, around things like M&A. Being unable to really know with any real clarity what kind of deal can get done in this economy with this White House.
Yeah, I would make a comment that the governments clearly need to look at policy, particularly in terms of foreign direct investment in sensitive industries and other things. That's always been present and will always, be a factor. So I wouldn't sort of point to one administrative, decision. But if you're involved in cross-border M&A and you want to invest in a market, it's a factor that you have to have examined. Whether you're in the tech sector, defense sector, banking, whatever it might be, you need to have that, really considered carefully.
To John's point, as you travel around, you hear from clients, how concerned are they about policies that may change drastically next year, depending on a change at the White House?
They're all asking the question. They're all asking, who's going to win and what will be the policy setting, and that's very sensible. Though, of course, the news announced yesterday in terms of the tariffs that the US is imposing may indicate that actually policy differential won't be that great, depending on who's in the White House. Of course, that's just speculation. But I think looking through that, it's really the volatility in the second half of this year that a lot of investor clients are looking at, and on the corporate strategic side, I think people just want to see a little bit more certainty. I'll talk about that range of potential outcomes on monetary policy around the world. But they want to see a little bit more certainty in the fiscal situation and also that policy setting. So they're not making big decisions necessarily leading into the election, but they want to be as informed as possible about what it might be straight after.
How are you preparing, given the fact that you've got clients in a lot of different countries, potentially even in China, at a time where we're going to get potentially a big disruption? How is that informing some of the restructuring that Citi has done in terms of not just the footprint and where you are, but how you are arranging your suite of products?
So nothing of our reorganization, not restructuring, but nothing of our reorganization that we've executed over the last number of months is to do on our geographic footprint. Indeed, we've reconfirmed the importance of our sort of global network and footprint. So what we have done, though, is sharpened our ability and our focus of our businesses, and also the capabilities that we have to address clients' needs, is make sure that they're directed very clearly towards the client. So where that network, that footprint, and so on, and that product set remains unchanged from what we had previously.
So you said that the reorganization has been largely completed, and yet there have been a number of recent exits, and I'm wondering how difficult it is to really retain some of the top talent at a time of churn, of change, which is always tough.
It is tough. I'd say that what we announced yesterday in terms of two senior retirements of T.D. Cole and Mike Whitaker, absolutely planned, all part of the execution that Jane Fraser, our CEO, had in mind. So this was normal and expected. But I'd go back and say, actually, our ability to attract very senior talent is high. Andy Sieg, who joined to run our wealth business, Tim Ryan, who we announced yesterday, will be joining us as head of technology and business enablement. This is very, very high-quality talent. There's Raghavan, who's joining us shortly to run our banking business. Top-tier talent, attracted to Citi, attracted to the opportunity and the platform that we have.
What do you think changed? Do you think something has changed to attract that talent? Is it something as simple as the stock price performance, which is up more than 60% since the end of October? Because Citi stock, as you know, without being too critical, for a lot of people it's been dead money for a long time. Starting to perform. Is that attracting talent? What is it that's changed for you?
I think you need to go well above the share price for that. I think it's clarity of strategy, and I think our chief executive has set out a very clear strategy, made some very clear decisions in 2021 in terms of some of the business activities that we would discontinue, and being really clear through this reorganization that of the accountability that she wants the businesses to have, but also to perform, and that I think is the factor which is attracting this talent.
Language is important. You keep saying reorganization. What is the difference? Just help me understand between a reorg and a restructuring.
I think restructuring implies that you're changing fundamentally your business mix. Also implies that you might be sort of divesting in certain things. It's not. We've had a management reorganization, so our structure catches up with our strategy, and we have a much simpler management structure than we had previously.
Seems to be paying off big time, based on the share price performance, because that's what I focus on. Citi's up this morning, or rather down just a little bit, but over the last 6 months or so, pretty phenomenal price action there. David, thank you, sir.
Thanks,
Good to see you. Thank you very much. David Livingston there of Citi. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Some of Japan's biggest banks say that they'll be seeing record profits this year. MUFG, Mizuho, SMFG all predict profits of over $21 billion taken all together. The banks expect earnings to grow thanks to strong loan demand. They also see an earnings boost from the BOJ's shift away from negative rates. Let's get a quick check on Burberry shares in London, trading lower more than 3.5%. The company warned of a challenging first half on weak U.S. and China demand. Now, the label has been trying to engineer a turnaround, but those efforts have run headfirst into cooling demand for brands that find themselves in the middle of the luxury market. For example, Gucci owner Kering has been struggling, while the more exclusive brands like Hermes have shown resilience. And the meme stock revival, it's finally taking a bit of a break this week. We're down pre-market 12% and 10% for GameStop and AMC, respectively, though not only after GameStop alone added $9.5 billion in market cap in just 48 hours. That rally was driven by the return of Keith Gill, a.k.a. Roaring Kitty, on social media. But it's gotten to the point where even the former bond king, Bill Gross, has strayed very far from the staid world of debt to trade meme stocks. Specifically, he's been selling option straddles that he described on X as 400% annualized volatility. That's your Bloomberg brief, John.
Danny, thank you. We'll catch up with Danny in about 30 minutes' time. Up next on the program, inflation data on deck.
If we get any sort of deviation to the upside, I don't think it brings back the idea of hiking, but it takes off the cuts, it pushes them back further. Rates can get really volatile today if we get an upside surprise.
8:30 Eastern time, we're all waiting for it. Inflation data just around the corner. Live from New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Equities are doing absolutely nothing. Nothing. Stay tuned for 8:30 when they might do something. Futures are going absolutely nowhere on the S&P 500. Yields are lower by 2 or 3 basis points on a 10-year 441.20. Under surveillance this morning. Inflation data on deck.
The market is in, as I said, very confident going into this number. If we get any sort of deviation to the upside, I don't think it brings back the idea of hiking, but it takes off the cuts, it pushes them back further. Remember, the last few big upside surprises, we've seen like 15, 20 basis points move on a day. So rates can get really volatile today if we get an upside surprise.
It's been very messy over the last few months. Here's the latest this morning. Treasury yields ticking lower ahead of the US CPI print at 8:30 Eastern Time. BMO's Ian Lingen writing this. Stronger inflation numbers will be far more bond bearish than a consensus print would be bullish. That said, we still suspect that a 0.3% core CPI print would initially trigger a bull steepening, albeit in range for the 2 to 10 curve. Ian joins us now for more. Ian, just develop that a little bit more, because that runs counter to what we've been told over the previous few weeks going into data, where people would say that risk are skewed asymmetrically to lower yields. Why is it the other way around for you?
I think to a large extent that the price action of the last week and a half has reset the market's expectations for what it would take to get 10-year yields to, say, let's go 4.30 or 4.25. We would need to see a 0.2 on core or lower. Right now, we priced in a relatively benign takeaway from the CPI data, and the onus is on the realized data and maybe even retail sales to drive the market further.
So, Ian, that's on the 10-year. Could we just go a little bit further forward to the front end of the curve and sit on the 2-year? How capped is the upside there, given the reluctance of this Federal Reserve to raise interest rates?
I think there's very little chance that we go back to 5% 2-year yields. If we do, it's a buy-in opportunity because Powell took a rate hike off the table. And if rate cuts get delayed, that will simply keep the front end of the market from rallying, as opposed to push rates to a defined higher plateau from here. So I would think anything that gets us close to 4.95 or 5% will very quickly trigger buying interest.
Ian, this is something we've been playing around with. How much does that alone, the idea that it's somewhat pinned in terms of the upside on short-term rates, how much fuel does that give to the rally that we've seen in longer-term bonds? You say that you actually question that. At the same time, that stability, that certainty has been enough so far to really fuel a lot of risk appetite, especially in the bond space.
I think that is part of what's going on, i.e. the longer-term assumptions for how high monetary policy rates can go. But also, let us not forget, we recently heard from the Treasury Department and they said that they have no intention to increase auction sizes for at least several quarters, which puts us into 2025 before we start worrying about supply again. So I think that's part of it. And then the jobs figures, they've been less great, not bad, but that combined with Powell's refocus on the employment part of the dual mandate has shifted investors' thinking about adding duration here.
With respect to the long end, are you viewing potentially a sell-off, at least in the near term, as stemming from just positioning? That people have gotten a little bit overly excited about the pace of disinflation and reintroducing even the chance of a July rate cut, and you think that that's premature?
Yes, I think that's a very good way to characterize it. I think that the market sentiment has swung too far in one direction, and without further confirmation from the data, we will retrace back into the range that we were in throughout much of this year.
When we talk about the potential for auctions and supply and the different dynamic, it raises a question about what kind of reaction there would be to retail sales coming in lighter than expected. To me, this is actually in some ways the bigger mystery than CPI that's been dissected again and again, and goes to this question of stagflation, stagflation light, stagflationary winds, whatever you want to call it. How closely are you watching that? And does a softer print really give that rally into the bond market, especially if it's paired with basically an inline print on CPI?
If we get an as-expected CPI number, even something within the range on headline, but that 0.3 on core, I think all focus will very quickly shift to retail sales. And keep in mind that retail sales is not an inflation-adjusted number, so it will be difficult for that to materially surprise on the downside. But when we think about the pace of consumption during the first quarter and the softening in the labor market, it follows intuitively that people will start to become nervous that we're finally beginning to see the anticipated impact of a restrictive monetary policy that's been in place for several quarters.
You're talking about potential cracks in the labor market. We had the Michigan survey on Friday, the New York Fed report on Monday. There's serious concerns, at least when you look at the sentiment of consumers. Do you yet see them starting to withhold some of that spending?
Well, we haven't seen it flow through to the data yet. And I think that that's the biggest concern, is people are starting to increase credit card utilization. People are starting to make fewer on-time payments. We're starting to see defaults increase. All of that suggests that there is some evidence that we're seeing a bit of a slowdown, but it hasn't made it through to the aggregate data yet. And I think to a large extent, that's why the retail sales print this morning could be such a wild card.
Ian, this is interesting, and I want to build on it. I want to ask you as a bond guy to talk about the equities just a little bit. Just sort of go with me if we can. A lot of people in equity markets are taking comfort from the idea that it doesn't matter how high inflation might be, how strong data might be, this Federal Reserve won't entertain another rate hike. And they see that as bullish. They take comfort from that. Even if we get an upside surprise on CPI a little bit later this morning, there will be people who want to buy that dip if we get one because of that very reason. Ian, what are the limits of taking comfort from that? Do you think we get to a point where high for longer is just as big a problem as entertaining the idea of an interest rate hike?
My biggest concern when it comes to the equity market is what it has been doing for financial conditions. It's been making financial conditions easier, which means that the Fed's runway to start cutting should be longer. And that becomes problematic when you think about it in the context of the wealth effect and the potential for the wealth effect and people's comfort with the amount of savings that they have actually driving inflation as opposed to being a reason to save because you're getting more of a return. So I think that that's one of the biggest kind of oddities of this cycle, is that stocks actually haven't retraced despite what the Fed has been doing. So I would be a bit cautious, especially if we have another material leg higher in equities.
Why do you think Chairman Powell doesn't share that view?
I think that he's worried about the wealth effect. And to some extent, I think that he has really doubled down on this idea that he can pull off a soft landing or a no landing quasi-Goldilocks scenario, and it would be great for his legacy as chair. It would be great for what this implies for 2025 and 2026. So if he can pull it off, if he can begin cutting rates and reassure the equity market and reassure business leaders that we won't be restricted forever. And I think that that is an ideal outcome for the real economy as well as for the Fed.
Given what you've just said, how serious should we take him about getting inflation back to target if legacy is everything and he doesn't want a recession? Are we also saying that maybe that pain speech back in Jackson Hole in 2022 wasn't a real deal?
I think that he believed at that moment that the real economy would or was risking suffering more pain. And I do think that above all, the Fed understands that reestablishing price stability is key. They're holding the 2% inflation target. It's now in the FOMC statement 4 times, and that's very telling. They're not giving up the 2% inflation target, and that part of Powell's legacy is a lot more important than avoiding a recession. But if he can have both, I think that's a win-win.
In final one, September, still the date in the diary for you?
I think it's most likely. It might change at 8:31, but for the time being, I think September, December.
I'll ping you a message at 8:31. Ian Lingen, thank you, sir, of BMO, breaking down this market for us, both bonds and stocks, and what he's looking for from Chairman Powell later this year.
Well, you've raised this question of why is it the financial conditions matter only when stocks are selling off, but they don't matter when stocks are rallying, which is essentially what we're dealing with the Federal Reserve. And the answer is, who knows, right?
We don't have one.
We don't have an answer. It's basically he wants to preserve a legacy of soft landing. And, you know, frankly, a rally in the market isn't going to necessarily challenge that. It's once people are struggling to understand, but right now, the market is still buying Powell because you're not seeing longer run inflation expectations run away.
Credit to Ian and credit to Powell, of course. Going back to 2022, there was a belief that you needed pain to get inflation down. Inflation has come down a lot without much pain, seduced by the idea that maybe that would continue. Are we going to flip back at some point to the belief that to achieve that inflation target of 2%, pain might actually be required?
This is my fear, actually, and this is the reason why stagflation was something that people were so worried about. But my fear is that still people are saying, okay, now finally we're going to get disinflation. It was just delayed. If that doesn't happen, how much do people start to really think about a higher inflationary environment? If it does happen and we get retail sales that also underperforms, how much do people say, wait a second, maybe things are slowing down in a more material way, and that's the reason why we're seeing inflation tick lower in a more substantial way.
Big 60 minutes coming up. Here's the lineup. Ed Yardeni of Yardeni Research, David Kelly of JP Morgan Asset Management, PGIM's Tom Porcelli. We are 34 minutes away from US retail sales and CPI. From New York, this is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy,
and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The consumer is starting to say that these prices are becoming, somewhat problematic.
The consumer has softened a little bit, which, makes some sense given all the pressures that are out there.
The one thing that's maybe causing people to go home are these whiffs of stagflation that we keep seeing.
The biggest tail risk is inflation, and if inflation spikes higher, that's the big risk.
The CPI data, I think, are going to show this continued trend that disinflation has stalled.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
This is what it's all about. 13 minutes away from U.S. inflation data, together with retail sales. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. 8:30 Eastern Time. They are the two data points to watch. This just dropped from Citi and Andrew Hollenhorst. Do not forget retail sales. Andrew saying this: we expect soft retail sales control group to show consumer demand is slowing, and why they think this Fed leader is on track for a cut in July.
This is really the key point here. If we get an inline print for CPI, which is expected, as we just heard from Ian Lingen, all focus goes to retail sales. If it comes in softer than expected, the bias will be back on the economy, given the fact that this is a Fed that really wants to see that soft landing.
And then you get the Fed speak, and you'll hear from some hawks. Governor Bowman, Kashkari of the Minneapolis Federal Reserve. It's going to be interesting to see how they respond to that data that drops in 29 minutes.
Potentially, it'll be what we've heard from them before, and they'll echo that maybe we won't see any rate cuts this year. I love Andrew Hollenhorst this morning, though. Also important retail sales. Ian Lingham just said to us in the last hour that they haven't yet seen in the data this lack of willingness yet from consumers to spend. But what we've seen in sentiment is that consumers are starting to get concerned.
Let's get to the scores. Equities right now just about unchanged. Take a look at this board. A total snooze. In the equity market, going nowhere. In the bond market, going somewhere. We're down 2 or 3 basis points on a 10-year. 4.4140. I think this is the definition, Lisa, of treading water in the stock market.
Yeah, you missed it. Yesterday we were treading water too, and the day before, guess what? Treading water also. Although at the end of the day, it was not treading water. It was like a sudden rally, and everyone was sending messages. What's going on? What's fueling this rally?
It's leaked.
It was leaked. It was a whisper number. It's going to come in light. Basically, people are looking for an excuse to rally, and that, I think, is how we're set up for today's data.
I love how those rumors start. You don't get a move, and everyone's like, it's leaked, and they start buying it.
It was hilarious. What's the whisper number? It must mean that people hear something.
It's in that GameStop as well, right?
Well,
it's like, what does it mean? I'm going to buy it just in case it means something.
Okay, you think so? You watch Roaring Katie?
It's a great case study for the broader market.
Is it?
No, as I often say, I say this a lot, just because you found a casino doesn't mean you're in Las Vegas. It just means you found a casino, maybe a roulette table. It doesn't mean the whole thing is an institution dedicated to gambling. This is a serious business.
Who are you talking to?
My friends,
I have no idea, but carry on. It sounds beautiful.
Connecting with the audience, all right?
Carry on, keep going.
Coming up in the next 60 minutes, Ed Yardeni of Yardeni Research. As global stocks rally ahead of US inflation data, and JP Morgan's David Kelly together with Tom Porcelli reacting to CPI and retail sales data, which is just around the corner. We begin with our top story, global stocks rallying ahead of key data due out in just a moment. Ed Yardeni of Yardeni Research weighing in on the state of the consumer, writing, quote, "There is mounting chatter that the consumer is cracking. We aren't cracking. They continue to predict that consumer spending will grow, and so will the economy." That's our story. We're sticking with it. Ed joins us now for more. Ed, good morning to you.
Good morning.
What do you say to the consumer confidence reads that say things are bad, terrible, and getting worse?
Well, you know, Americans are extraordinary. When we're happy, we go shopping. When we're depressed, we go shopping even more. But I think consumers are still shopping, and I don't think they're dropping. And I do expect retail sales is going to be on the weak side because we had some weak income numbers for the month. But that's retail sales, that's merchandise, and people are spending a tremendous amount on services. I mean, getting through airports these days is just a real pain. Everybody's traveling, getting into restaurants is difficult. All the baby boomers are retiring, and they're having fun.
Particularly Terminal 4 at JFK, which is absolutely awful.
Well, yeah.
Can I just say, I hate Clear.
Awful.
The whole thing. It basically is this
I
big
stopped
system.
it. I'm just doing TSA.
Clear helps you at some terminals, doesn't help you at others.
But it's pay to play. Otherwise, they go in front of you and carry on.
Clear with TSA pre-check is pretty quick. Okay.
Yeah.
Yeah, I went TSA pre, believe me. Very long line. Got things to say about Terminal 4, which I'll save for another day. Ed, are you saying that if we get a disappointment at 8:30 Eastern on retail sales, not to read too much into it?
Absolutely. I mean, we know that consumers went on a buying binge for goods once we got freed from the lockdowns during the pandemic. And we all wanted to, you know, get some fun, do some shopping after the lockdowns, but we couldn't do it in services, so it was a big buying binge for goods. And that lasted, I figure, until early 2021, about March, was when the services started to open up, and we've seen a tremendous amount of spending on services. So, yeah, it's a month-to-month kind of number. I do expect it'll be on the weak side, but I think it'll be offset by services.
The Yardeni household sounds like a lot of fun. It's like sad, buy, happy, buy. I'm curious, though, about some of the conflicting data. We have Bank of America credit card data that shows actually an increase in spending with all the different income brackets. Citi credit card data showing the opposite, actually showing some sort of disdain. There's discussion around a shrinking pile of savings and what that might do. What's your lodestar at a time where everything is sending a different story depending on where you look?
Well, I'm a card-carrying member of the baby boom generation, and a lot of my friends are retiring. I'm still working for a living because I had 5 kids, so I'm still supporting a few of them. But the baby boomers are retiring. Many of them only had 2 kids. Kids are adults. And what are their baby boomers doing? They're spending their retirement money. So they don't really need to spend on credit other than just for convenience, and then they pay it off.
So a lot of people are looking for confirmation of either a Goldilocks slowdown or potentially in a negative situation, stagflation. If we see, for example, a disappointing retail sales number and you see stickier CPI, even comes in above where we are, why should people dismiss that and not talk about stagflation at a time when it makes logical sense why that would happen?
Well, I'm in the same camp as Fed Chair Jerome Powell. I think in his press conference he said something like, you know, there's no stag and there's no inflation. So I can agree with that. Economy is doing fine, and I think inflation is on its way to 2% by the end of the year. I mean, the CPI, excluding shelter, and by the way, I always take out what doesn't support my story. But,
we all do. Carry on.
But I'm
so does the chairman.
Fair point.
But I take out shelter, and we got a two handle on the CPI. I think you'll see the same thing today, and I think the shelter inflation rate's coming down. As we all know, it's kind of a bizarre component of the CPI. So I don't see stag, I don't see inflation. I see the economy doing quite well, and the stock market seems to be on board with that.
Yeah, and a lot of people see that continuing. There is this question, just in a larger picture. You talk about the roaring 2020s, how much of it's being fueled by industrial policy, frankly, and this incredible investment in bringing back manufacturing. How much is that something that you want to ride in, for example, the copper rally, as well as the equity rally? How much are you seeing it sort of priced into stocks and now being priced in more to other areas that might be a little more inflationary down the line?
Yeah, well, the roaring 2020s scenario, I think, started to get discounted by the stock market. On November 30th, 2022. That's when OpenAI introduced ChatGPT. And ever since then, investors have been looking for ways to play artificial intelligence. And they did that first with NVIDIA. And then just a few days ago or a few weeks ago, we started a utility rally. So all of a sudden, utilities are plays on the power play on AI. And now copper has been going straight up. So I think it all is the market's way of validating that things are actually looking pretty good, that a lot of people are making bets that AI is going to be an important source of productivity, and I think it will be.
But you lean into that. There's more to go.
Yeah, I think there's more to go.
When it comes to the consumer, you say that they keep shopping, but the Michigan survey sentiment is very low.
Right.
Also, the New York Fed report says that inflation, their concerns, their inflation expectations are much higher.
Right.
How do you make sense of the two?
Well, the Consumer Sentiment Index is very much influenced, it reflects inflation much more than the Consumer Confidence Index, which reflects more employment. And so I think that people are kind of still annoyed, very annoyed, that prices are much higher than they were before the pandemic or even a couple of years ago. But a lot of the sensitivity of the Consumer Sentiment Index, the Michigan survey, is in fact gasoline. It's the most widely seen price that you pass it every day. And so the price of gasoline has been coming down over the past couple of weeks. I think that'll continue to be the case. The main reason it went up a few weeks ago was because of all the geopolitical risk. But the price of oil has actually been coming down, and so has gasoline prices. So I think that'll relieve some of that.
Ed, I'm happy to say you're going to be sticking with us. Ed Yardeni, looking ahead to the Roaring '20s. I mentioned this in a commercial break. You don't see the commercial break. I was thinking about this last night. It's 2025 next year. We're halfway through Ed's call of the Roaring 2020s.
And guess what? So far, it's been right. And frankly, it has been sort of turbocharged from 2022. The legs, the tentacles of this is what I'm wondering. And when we were talking with Evan Brown about the widening out of the exceptionalism of the U.S., how much of that is because everyone's getting on board with investing in industrialization, and that's essentially fueling the copper plays and the utilities plays, et cetera.
We can talk about this in a moment, but the sector composition interests me. We used to think about tech as purely offensive, and then there became this sort of defensive secular trend involved as well. So people used to start talking about it being defensive, and now utilities, typically defensive, but now offensive because it's tied to the AI theme. I can't keep up. I'm not sure what part of the market is for what anymore.
Yeah, what's growth, what's value?
Right.
I mean, honestly, all of these names, the different factors are getting more and more muddied as we get further along. You're right to say about utilities. Is that almost an aggressive play on AI? How many people do you hear about that? Going to small towns, can you build out infrastructure, utility shop, cool some of the
data centers?
The data centers.
Oh, yeah.
I find that so interesting.
I know, from a real estate perspective too.
Yeah.
Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Speaking of AI, Google Glass may be set for a comeback thanks to artificial intelligence. At the company's annual developer conference, Google unveiled Project Astra. It's a new AI assistant that can theoretically react to the world like people do, responding in real time to what it sees and hears through a smartphone. Now, video during the event showed a pair of glasses with a built-in camera and visual interface. Executives confirmed that they're experimenting with the idea of making glasses for Project Astra. OpenAI's chief scientist and co-founder Ilya Sutskever is leaving the company. There had been months of speculation about his future after he had played a role in the brief ouster of Sam Altman last year. Sutskever had clashed with Altman on how rapidly to develop AI. OpenAI announced that he will be replaced by its research director, Jacob Pachoki. Now, a new potential buyer has emerged for TikTok's U.S. business. Real estate billionaire and former L.A. Dodgers owner Frank McCourt said that he plans to build a consortium in what he described as, quote, the people's bid. He joins a diverse group who expressed interest in buying the platform. That includes former U.S. Treasury Secretary Steve Mnuchin and former Google CEO Eric Schmidt. Now, whether or not any of them can actually buy TikTok is a completely different story. ByteDance, of course, has said it has no intentions of selling the asset. And that's your Bloomberg Brief, John.
It's a minor detail, Danny. We'll catch up with Danny again in 30 minutes. Up next on the program, the morning calls before we set the stage for CPI and retail sales. That's all coming up next. That conversation just around the corner from New York. This is Bloomberg.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
So here's the state of play going into CPI and retail sales, about 15 minutes away. Equities just a little bit negative. The emphasis again on a little bit. We're down by 0.02%. Yields are lower by 2 basis points. The 10-year 441.59. It's time now for the morning calls. First up, Morgan Stanley resuming coverage of ExxonMobil at overweight, seeing attractive growth after the acquisition of Pioneer. Next up, JP Morgan upgrading NEO to neutral. The analyst expecting shares to benefit from China's stimulus policy and higher auto demand. And finally, Bernstein upgrading General Mills to market perform, expecting a stronger second half of 24 and improving macro environment. All of that still to come. We're looking ahead to CPI and retail sales in about 14 minutes' time. Ed Yardeni is back with us around the table. Ed, we've been talking about defense and offense. I want to talk about which sectors to use to do what. We mentioned it before the commercial break. Utilities were almost exclusively defensive, and now there's seemingly this AI theme to it. Have things changed in the stock market?
Yeah, well, it's a moving target for sure. I mean, I'm sticking with what I've been promoting or recommending as overweights, and that's technology, industrials, and communication services. I think those continue to do well. But meanwhile, we're seeing a lot of materials are doing quite well. You know, copper-related stocks are doing extremely well. I think it's becoming a broad bull market. I think you just stay with it.
Early stages? A lot of people would say we're late cycle, getting towards the closing end of this.
I've got 5,400 on the S&P 500 by the end of this year or the end of this week. I'm still working on the timing.
Might be the end of this week.
Might be the end of this week, the way things are going. But then 6,000 next year and 6,500 by 2026. So that's a 25% increase from here. That's pretty reasonable. So I think my forecast is a sustainable long-term bull market.
Ed, you said in the break that the biggest risk right now is a melt-up.
Yeah.
And that any rate cuts by the Federal Reserve would be a huge mistake.
Right.
Why do you say that? Why would a rate cut fuel another leg higher that would be such a big mistake?
Well, the bull market is just constantly stampeding over my forecasts. I mean, last year I thought we'd get to 4,600 by the end of the year. We actually got to 4,800, and we got to 4,600 by the middle of last year. And here we're already at over 5,200. I thought we'd get to 5,400, which seemed like a pretty aggressive forecast. But now people are asking me, are you going to be raising your number here? So, look, I think that the concern I have is if the Fed really does start lowering interest rates, I mean, that could really create a melt-up, and that would be an issue for me.
We've been talking about this extensively, the idea that Fed Chair Powell doesn't seem to think that financial conditions are a problem when the market's going up, only when they're going down.
Right.
Why do you think that is?
Well, I can't really figure out what Powell's thinking, because he has been actually fairly dovish, while some of his colleagues have been more on the hawkish side. I think it makes more sense for the Fed to provide guidance that they're not quite sure that they've gotten inflation down, and that they're not only in no rush, but they're not necessarily, you know, in the camp that interest rates have to come down. My view is that the Fed has actually normalized interest rates. This is where they should be. I don't think they should be thinking about bringing interest rates down aggressively, because the economy's demonstrated it can do just fine, and the stock market's doing just fine, and bond market's kind of hanging in there pretty well.
And if Powell was to say that and claw back this idea of a rate cut this year, how bearish would that be for the market?
Well, I think the markets have already demonstrated that they could live with disappointments on the interest rate outlook. I mean, we started out the year with the markets thinking 6 to 7 rate cuts. I couldn't figure out where that was coming from, other than from all these people who thought we were going to have a recession for the past 2 years, and that was sort of their stealth way of saying we're not out of the woods yet. And there's still people talking about a possible recession here, but all in all, I think you know, if everything's working out well, why mess with it? And that if you should just say that, I think that would actually be reasonable and consistent with what the data has been showing.
It's clear to us, based on what you've said, that this 5,400 price target on the S&P is not dependent on Chairman Powell cutting at all this year. Is that fair?
Absolutely.
What could derail it?
Well, I think clearly if we get some continuation of some hot inflation news, that would be an issue. I don't think that's going to be the case. You know, we'll see how the CPI comes out. I mean, every time we get a CPI, it's the most important CPI we've ever had in our lives.
Because it is, Ed. Don't kill it.
Yeah.
It is. The most important one until the next one and since the last one.
Until the next one. And meanwhile, the
game.
market just kind of has learned to, you know, take it all in stride and just keep going higher.
Are there limits to that? After 3 upside surprises this year, are there limits to that?
Well, certainly there's already people kind of thinking about the possibility that the Fed may have to consider raising interest rates. If that suddenly becomes a reality and they start talking about that, I think that would certainly be good for a 10% correction.
If you think that the biggest risk to your outlook actually is an upside melt-up, right? And that the biggest risk is that the Fed does cut rates and that is what ignites the rally. Right. How much would this market rally if we get a July or September Fed rate cut?
Well, I mean, we'd blow right through 5,400 in a heartbeat. And then I think we could very well get to my 6,000 target for the end of next year by the end of this year. So, you know, I think the market, there's a tremendous amount of liquidity out there. $6 trillion in money market mutual funds. A lot of them are invested actually in repos instead of treasuries. So you put it all together, and it could be a pretty powerful bull market.
This is a fascinating call when you put it together, that essentially a Fed rate cut, if there are no rate cuts, it doesn't affect your 5,400 call. If there are any rate cuts, that could significantly affect the call.
That's right.
Is that kind of where the market is right now? There is an asymmetric risk where essentially higher for longer doesn't make anyone worried, but rate cuts will turbocharge what we've seen.
Well, we've already seen that people are looking at this Citigroup Economic Surprise Index, and it's come down quite a bit, and that's actually been supportive to the bond market, and in turn, it's also been supportive to the stock market. Now, why would disappointing economic indicators be good for the stock market? Because the market would just love to see the Fed cut interest rates.
Yeah, and we've heard that again and again from a lot of people. Just quickly, you're looking for maybe a downside surprise on retail sales. CPI in 8 minutes, what are you looking for? 0.3, like everyone else?
Yeah, like everybody else. And gasoline prices may have boosted it, but they're going to reverse that next month.
Ed, have you had any research looking ahead to this economic data? 8 minutes away, standing by, Mike McKee, our economics and policy correspondent. Mike, what's the big focus for you, sir?
Well, we're going to start with housing to see if that Godot of economic indicators finally shows up and we get a decline in home prices, but also going to be looking at the insurance numbers. Remember, auto insurance in particular has been rising at a crazy rate, and so that has pushed up CPI quite a bit. Those are the important things, and we'll see then what Americans are buying with retail sales. It is a big drop that is foreseen in the retail sales core numbers, and that could make a big difference in the outlook for the second quarter.
Mike, just can you set the record straight? Yesterday, as we headed into the end of the day, the close of trading, there was actually a pretty substantial rally, and people were saying, why? And there was a rumor, as there are wont to be, that it was a whisper number that came out. Is that basically what you're hearing, that the guidance from a lot of people is that downside surprise that has been fueling a lot of this optimism?
I'm not sure that's the case. I mean, people want to believe what they want to believe. The thing about the CPI is that most people get that right. Most economists get that right. It's fairly easy to figure out compared with retail sales, which are constantly heavily revised. So the retail sales would be based more on anecdotal feeling, while the CPI is probably based more on Excel spreadsheets.
Mike, what's so important for you under the hood in the CPI report that trickles down into PCE?
Well, you're going to be looking at hospital and medical care, especially for social work medical care, and we'll be looking at insurance and airfares. But the big thing that has moved the PCE is the portfolio management category, which was up a lot in the PPI. We'll see how it comes out in CPI.
Mike, it's amazing. Some people reacting to that, asking why on earth it's in there. Typically, we refer to PPI as factory gate inflation. What on earth is that doing there?
Well, it's calculated different ways. One is how much people pay for the services, like if you were paying Ed Yardeni for his services, and then the PPI is looking at what Ed Yardeni is charging for those services. So there may be a kind of a difference. There's also some methodological issues.
Mike, before you go, I want to look ahead to the Fed speak as well. We'll hear from Kashkari, who's open to the idea of not cutting at all this year. Governor Mickey Bowman, someone you followed a lot, who's basically told us she doesn't think we will cut this year. How much company do you think those two are going to get on the FOMC in the upcoming meeting?
I don't think we get a huge amount. Jeff Schmidt from the Kansas City Fed said last night, it's not one number. The market will focus on one number, and Kashkari and Bowman will get a lot of ink if we do get a surprise to the upside, and it makes it look like we're going to push out rate cuts. So they'll get a lot of talk, but I don't think it'll have a huge impact yet. It will have a big impact on the markets, given the dearth of other numbers other than PCE at the end of the month before the next Fed meeting.
True, and it always does. Mike, stay close. Mike McKee, 5 minutes away from breaking down economic data for you. There is not just one number, there is many. I can tell you on the Bloomberg terminal, there's like 15. Loads of CPI readings, a lot of retail sales. All of that is just around the corner. We'll break things down with Mike McKee, get reaction from him, and then a first-class lineup for you. David Kelly of JP Morgan Asset Management, Tom Porcelli of PGIM, responding to that data dropping in about 4 minutes' time. Equity futures trading water live from New York. The data up next.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Hey, this is what you've been waiting for. Retail sales, CPI data just around the corner, the scores going into it. In the equity market on the S&P 500, totally unchanged. In the bond market, a 2-year, 10-year, 30-year, shaping up as follows. The 2-year, 477.65. Bear in mind, last time we got a CPI print, upside surprise, saw a move of more than 20 basis points at the front end of the curve. With your economic data this morning, here's Mike McKee.
Well, we're waiting for the numbers to drop, and they've just fallen, and we have a downside surprise to CPI. Comes in up 0.3%, as does the core rate for the month. So that pushes the year-over-year CPI to 3.4% from 3.5, and ex-food and energy, the core, to 3.6 from 3.8. So an inflation story that is good news for the Fed for once. Everybody react in the bond market, please. Retail sales come in little weaker than expected, 0.0%. Last month revised down to 0.6%. Ex-autos, 0.2% from 0.9. The core group, which is what we really care about, is down 0.3% after a 1% rise the month before. So at this point, what we're looking at is a economy that seems to be slowing down, consumer spending slowing, but prices dropping at the same time, which could be a recipe for Fed rate cuts if you want to hurry up and overreact.
And the market reacting to it, Mike McKee. Not for me to say they're overreacting, but certainly reacting to it. We often say the first move isn't always the right move, but this is certainly the initial move. Equity futures positive by 0.6% on the S&P, the Nasdaq moving higher by a similar amount. On the Russell, up by 1.5%, and you can say thank you to the bond market. Switch up the board. In the bond market right now, double-digit move at the front end, lower by 10 basis points on a 2-year to 471.32. We're down by 10 basis points as well on a US 10-year to 433.61. If you turn to foreign exchange, you can guess what the euro is doing against the US dollar. The euro is stronger by 0.5% at about 108.69. Congratulations to the 63 of 68 people surveyed in our Bloomberg survey for CPI, Lisa, looking for 0.3 on core, and 0.3 is what they got.
They got it exactly on the dot, and frankly, this is the rally that everybody was expecting as well. As we pointed out, about 49% of people who were surveyed by 22V Research expected just this result. Question I have is, though, where does retail sales fall into that, given the fact that when you take a look at some of the control groups, the control group in particular, down 0.3% versus a gain of 0.1%. When is that not positive necessarily to the momentum of where this is going?
That's retail sales. CPI, if you are just joining us, headline month over month coming in at 0.3. The estimate in our survey 0.4. The previous read 0.4. Stripping out food and energy, we get 0.3% against an estimate of 0.3 and a previous number 0.4. Mike McKee, as you lift the lid on the headline stuff and get into the detail, what stands out for you?
Well, we did not get a big drop as we had hoped in terms of the owner's equivalent rent and the real estate portion of CPI. Owner's equivalent rent comes in up 0.4, which is the same as it has been for the last several months. Rent of shelter comes in at 0.4%. So no real change there. Gasoline prices were up 2.8%. Food, though, was flat on the month, so that contributes to a slightly smaller impact overall. I'll keep looking through those numbers and get you some more. Taking a look at the retail sales numbers, it looks at this point like motor vehicles really made a difference, down 0.8%. So that subtracted a lot from the top line number. Other than that, sporting goods down 0.9, but clothing up 1.6%. Food and grocery stores up 0.6%. And the food services and drinking places, which is kind of the one services industry thing we get, is up 0.2%. So at this point, the weakness seems to be in in areas that are not directly, not something people spend a lot of money on a regular basis. You don't buy a car every day, but the things that people were spending money on still saw increases. So I'll let the smarter people analyze all that.
As we put it together, what we're seeing in markets is basically almost a full pricing of a September rate cut as people bring forward the idea that this is the disinflation that so many people have been looking for. You took out owner's equivalent rent. Is that essentially what a lot of people are doing at this point? We heard from Ed Yardeni just now. He cuts that out. A lot of people saying that's noise, focus on the other. Is that what we hear on the Fed as well?
Well, that's kind of what the Fed is going to do. They know that the numbers are lagged in terms of housing, and so they know it's going to take a while for that to come down. It's taken a lot longer than they anticipated, but it isn't really representative of what overall inflation is doing, which is kind of why Jay Powell brought up the supercore. Supercore does rise on a year-over-year basis and a month-over-month basis. Let's see what we get, 0.42, which is down on a month-over-month basis, up a little bit year-over-year, but the supercore, which takes out housing, does show some progress in terms of services inflation.
Mike McKee, thank you, sir. Stay close. We'll come back to you. 9:35 p.m. in Tokyo, Japan. Raise a glass to the Ministry of Finance. I'm sure they're happy with this. We're down about 0.8% on dollar yen, 155.20, down 0.8%. A stronger Japanese yen, a weaker US dollar. If you are just joining us, the data shaping up as follows. 0.3% the headline number. The estimate was 0.4. Looking at core, stripping out food, stripping out energy, 0.3. The estimate was 0.3. Equities are higher. Bond yields are lower. The dollar's weaker. We've got a stacked table here in New York. David Kelly of JP Morgan Asset Management, Tom Porcelli of PGIM Fixed Income. Gents, good morning to you. David, first to you, your reaction.
Well, I think what we've got is a moderate moderation in the U.S. economy, both in terms of growth and inflation. Inflation it's taking its sweet time coming down, but we still think it's a downward trend. And I think, the reason for the market reaction is that we didn't get an upside surprise. So we've now had 3 reports. We've had the jobs report, then we had the consumer sentiment report, and now we've had the retail sales report, and they're all saying, overall things are moderating here. When you look at the JOLTS number, things are moderating. We've got fewer job openings. So it looks like the economy is just easing itself into sort of a 2% corridor of 2% growth, inflation gradually coming down towards 2%. And that's very good news. And I think the good news is that we didn't get another upside surprise in CPI today.
Does that whisper of a July cut grow a little bit louder after this, or is July still too soon?
I don't know if the whisper, I mean, it's already been a whisper. I don't know if it can become less of a whisper. I think it sort of stays where it is, which is to say, around 25%. I think that's probably reasonable. It doesn't go away, though. I think that's the important thing on the back of this. So I think it could probably still linger. But I think as a practical matter, it's probably going to get pushed a little bit, and I have no challenge with that. In fact, one of the things that I've been sort of critical of Powell when it's been mostly deserved. But
there's no pushback around this table.
But recently, I think he's done a good job with the narrative, right? Like I think after the last presser, and actually the presser before, where he said, "Hey, look, we're not going to overreact to a couple of sort of strong string of inflation reports, just like we didn't overreact to a really soft string the last go around." So I think that this to me is a chair who wants to cut. I think that, and you can easily see one, and I think if he has the opening, I think he'll do 2. And I think data like this, if it persists, I think that'll give him that opening. And sorry, I'll make this one last point, and I think David rightly highlighted this. If you look at that control number on retail sales, I mean, it was pretty weak. And again, no one's making the case that we're sort of falling off a cliff here, but I think things are slowing down. And that would be consistent with the Fed having the ability to cut.
We were just speaking with Ed Yardeni, and he doesn't necessarily have the same kind of sanguine outlook that you do with respect to Jay Powell, because he says, honestly, the consumer is strong. That, yeah, there was weakness in the control group, but as Mike was saying, it has to do with auto sales. It's not the sort of broad-based people not going out and spending things. Yep. So at what point, David, do you look at that and say, you know what, things are fine now. Why the rush to cut? I know you are in the please cut now, and you should have already cut camp. But why is it not that we see things are just fine and you should stay in here and only a cut would turbocharge a rally, which is exactly the reaction we're getting today?
Well, I think you should normalize interest rates. I think the Federal Reserve for a long time has been trying to micromanage the economy with rates that got too low and too high. I think it messes with financial markets. And, the more the Federal Reserve tease off financial markets, the more financial markets sort of act like sort of babies here. I mean, you shouldn't have had this much of a reaction. But you get this reaction because of the Federal Reserve is so sensitive about saying anything that might offend the markets one way or the other. When economic numbers are a little bit off one way or the other.
Isn't it fair to say their reaction function is set up for us to be hypersensitive to data?
Yeah, I mean, I think markets have an overreaction function. That's the problem. And so markets just overreact. And so the Federal Reserve, you kind of have to expose the markets to normal policy. Normal policy is if the economy is doing okay, rates ought to get back to normal levels. And I do think, I don't think July, but I do think September is possible. It's there, and I think Jay Powell himself will actually make a decision as he heads towards this about whether he wants it himself. Because the one thing that we've seen about Jay Powell, which is very clear, is he wants to build consensus and he works hard and actually lobbying. I wouldn't say lobbying necessarily is the right word, but he does. It's a good word, but he does talk. I think it's amazing that he talks to all 19 participants of the FOMC meeting before the meeting and just, this is my view and so forth. And that's why he's been able to get so much consensus. So if he thinks that, look, let's get going on a slow rate cut cycle before the election so we can, and let's get it going here so we can't be accused of playing politics. I think he might well do that in September.
Tom, you seem eager to weigh in.
No, I agree. I think David is completely spot on. Look, I think this is just a recalibration cycle. This is not, people hear cuts, and I think that immediately conjures up the images of the Fed like getting aggressive. Like, we don't think that that's the case. We think that this is going to be a sort of a very modest reduction in funds.
But talking about markets as babies, right? Yep. This question of how they react has been basically a feature, not a bug, of financial policy. Yeah. This was the transmission mechanism. We've been talking about this all show. How much do we get a rally on the idea that we're going to get a cut? And that's going to be a problem. It's going to set us back further and actually cause this to be more of a problem and more sticky.
Well, I think the Federal Reserve makes a big deal about how they don't allow politics overrule what they're doing. They should also do the same thing about market reaction. So they should not overreact to how the market reacts to either economic numbers or their own policy. But also, what they need to do is, and I completely agree with you on a recalibration here, because what they need to talk about is not monetary easing, but monetary normalization. The truth is, I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment. Yes. There's nothing wrong with 4.5% on a 10-year Treasury. That's actually about right, given a 2% inflation.
Normal for Fed funds?
I personally think normal for Fed funds is somewhere between 3.50 and 4. I mean, in the 50 years before the financial crisis, it was 2% above core CPI inflation. That would be 4 in the long run. I think, somewhere 375 to 4 would be about right.
No, I mean, I just found my new best friend.
It's love. Look at this. Carry on.
No, I think yes, I agree. I mean, I think I think that's exactly quite right. I think that this, to me, is I think this is the right way of thinking about where we're going. I think 3.5 to 4% is probably the right range to consider this in. And the good thing about that is, that is roughly what the market is expecting. So I don't think that there has to be some big recalibration as it relates to the market, because expectations seem to be roughly right. Although the market has tended to take things way too far. Let's be honest on that.
We'll get to the market right now. Equity futures are positive off the back of this economic data. I know a few of you just tuning in. This is what you missed. 0.3% is the number for CPI. 0.4 was the estimate on a headline basis. Stripping out food and energy, 0.3 against an estimate of 0.3. The Russell outperforming. The small caps up by 1.4%. Thank you to the bond market. Treasuries rallying, yields dropping across the curve. The 2-year down about 7 basis points now to 4.74. Mike McKee still alongside us. Mike, you've had longer to read through this. What stands out now?
Well, a couple of the categories that people watch closely performed pretty much as expected in that used cars were down 1.4%. Insurance, health insurance only up 0.3%, but unfortunately, auto insurance still posting a big gain, 1.8%, down a little bit from last month, but still an outsized gain. And John, you had a probably good discount on your trip to Paris this week because airfares were down 0.8%, which is kind of interesting because the CPI tends to include what people are buying for vacation time ahead. So we'll see if airline fares can continue to behave.
Just for the record, it was Taylor Swift weekend in Paris, and I booked the flight, I think, a day before I got it. So, Mike McKee, that was not cheap at all, just for the record.
Did you enjoy the concert?
I didn't get to watch the concert. But it was very busy. Can you imagine me at Taylor Swift concert?
Yes.
Mohammed went.
I know.
Mohammed's going to be on the program on Friday.
Bright pink.
Pink
It was
t-shirt,
fantastic. He said it was
spotted.
amazing.
Did he really think he wouldn't be seen in that t-shirt?
All I know is he's now a Swiftie.
Mohammed's going to join us Friday for a review of the economic data and apparently a review of the Taylor Swift performance in Paris, France over the weekend. David Kelly, I want to come back to the Federal Reserve, certainly not on Taylor Swift. You've said repeatedly that the Federal Reserve should just have faith in the calendar. This is going to work itself out through the next 12 months, regardless of how restrictive they think they are. Is that still your stance?
Absolutely. I mean, if you look at airline fares, I mean, you know, we've actually got air travel back above pre-pandemic levels. There's plenty of demand out there, but the airline industry is competitive enough for airline fares to come down. But overall, you know, in some areas of services and throughout the goods industries, what we're seeing is enough competition to gradually push inflation down. So this is not an inflationary economy. The only time it's an inflationary economy is when you have a huge supply chain disruption and you have huge fiscal stimulus where you're giving money to low and middle income households. That is the one way you can generate significant inflation here. Once you take that away, inflation will gradually drift down, and that's exactly what it's doing. It's just very gradual.
Tom, do you think a lot of this market reaction, though, is actually the CPI or the retail sales? Because CPI is pretty much in line. Retail sales was much softer.
Yeah, I mean, you know, it could also be a sort of a better than feared, because as we were saying, I think before we were on camera, you know, this could have easily been a 4/10. So I think it could have been some of that for sure. You know, the thing too about inflation, so I just think, look, I don't know about the wisdom of stripping out an assortment of different things like, you know, supercore. I mean, you're stripping out 50% or more of the weight of inflation, which I have no problem stripping things out of inflation. But what I would say is, if you want to do that, then I don't know, then go the next step, right? Because what we know is that auto insurance has been a thorn in the side of inflation. There's nothing the Fed can do about that. And if you strip that out, inflation looks even a little bit better. So to me, that's just keep in mind there are some idiosyncratic sort of sectors that are really impacting inflation that the Fed has no ability to control. So in that context, I think it's an even better outcome.
And also, I mean, the Fed, for good reason, sets a target at 2%, but no economist will honestly tell you there's a big difference between 1 or 2 or 3. Exactly. You know, so long as you're there or thereabouts, you know, you're okay. And then what you do is do no evil. Do not distort financial markets by having rates at a significantly incorrect level.
So then should the Fed just be targeting 2 to 3%?
Well, in Canada, they have a range of 1 to 3%, and I kind of like the idea of a range of 1 to 3% as a target. We get in that range, and we're fine.
I totally agree. In fact, I always use the RBA. I know, this is terrible. I'm sorry for you all.
Carry
on.
Just go for a drink, start the weekend early.
Exactly. David's using Canada. I've used the RBA as a great example, and the RBA has a range, and I think a range is saying 2.0% to me just strikes me as like the pinnacle of hubris. I mean, like, you rarely sit at 2.0% for any period of time. I think a range is really the right way of thinking about inflation.
And it actually caused tremendous problems last decade because they kept rates way too low for way too long as they were trying to get inflation up to that 2% target. Yep. And that fueled a lot of the asset bubbles and real estate bubbles that we're now suffering from.
So anyone who took the survey, the University of Michigan survey last Friday, who's listening to this says, what are they talking about? They're in Goldilocks land. Everything is amazing. It's going to be a great economy. Stocks are going to keep rallying. We can sustain this. Jay Powell is great. Where is the disconnect here between the idea?
Okay. Yeah, sorry. So it's an important idea. I think about like my parents, right, who haven't the foggiest idea what I do for a living. I mean, even after me trying to explain it to them. But you know, when I tell them, look, you know, inflation is, because they're always asking, what's happening with inflation? I'm like, oh, it's improving, you know, not to fear. And my father loves to say, like, what the hell are you talking about? He's like, I'm going to the store, I'm still paying a lot more for stuff. Mm-hmm. And that's the disconnect between Main Street and Wall Street. Like, we look at the percent change, and they look at price level terms. And price level terms, it's still incredibly elevated, and that's a problem, by the way, from a consumption perspective, because a lot of these things are fixed costs, like auto insurance or like food prices, that will actually continue to chew into disposable income.
Okay, that's been basically the theory.
I have to say, you need to fade that University of Michigan Sentiment Index surprise because they had a change in methodology. They're starting interviewing people on the web as opposed to on the phone, and apparently
they don't call us anymore. I've been waiting for that call for ages. 500, 600 lucky people.
Well, yeah, exactly. Well, now you get asked on the web, and apparently you're more gloomy when you're looking at the screen.
But David, how antiquated is calling someone on the phone?
Oh, no problem at all. But the problem is that they changed methodology and they didn't do a level adjustment for the bias that they know it's actually causing their data. Right. They put something out. I mean, this is really technical, but just...
No, I love this stuff.
It's
not... More. What do they actually ask, and how do they filter out answers like, I think inflation's going to be 20%?
If they don't do a fix to this, the University of Michigan survey will be about 6.6 percentage or index points below where it was a few months ago forever. Right. So it just, this change in methodology actually messes up the numbers. So I know everybody gets excited if a number misses consensus by a lot, and that happened, but nah, it was just a technical
final word, please.
Yeah, again, just to amplify, I mean, just keep in mind, for whatever the confidence numbers are worth, confidence has been pretty downbeat, yet spending has been pretty robust on a relative basis, right? So we're faders of the Michigan numbers too, but I think...
We now.
Yeah, exactly. but I think the inflation expectation numbers within Michigan, I think, are really useful.
Sometimes it's nice to get along. Gents, this was great. Thank you. Tom Porcelli of PGIM alongside David Kelly of JP Morgan Asset Management. Equity futures here positive by 0.6% on the S&P 500. We've said a few times on this program, inline is like the new beat for economic data. Inline on core, enough to trigger an upside surprise, or rather a rally in the equity market. Downside surprise on retail sales, maybe adding some fuel to that move. We're down at the front end of the yield curve on a 2-year by 9 basis points to about 473. Let's give an update on stories elsewhere. Let's cross over to Danny Berger with your Bloomberg brief. Hey, Danny.
Hey, John. Shareholders of BHP and Anglo American expect BHP to come back with one more sweetened bid. Anglo has twice rejected bids from BHP, but shareholders in both companies told Bloomberg that they think a third one is on its way before a May 22nd cutoff. Anglo, for its part, said it's going to exit diamonds, platinum, and coal to try to appease shareholders. BHP has said it will remain disciplined in its pursuit. Boeing may face criminal prosecution after the U.S. Justice Department said it violated an agreement tied to 2 deadly crashes 5 years ago. The $2.5 billion settlement reached in 2021 had allowed Boeing to avoid criminal charges, but according to a recent filing, Boeing breached it by, quote, failing to design, implement, and enforce compliance in preventing and detecting violations. Now Boeing has 4 weeks to respond before the next steps are decided. And Comcast, as many others, are betting on the return of the bundle. Comcast said it will offer a streaming package which will include Apple TV+, Netflix, and Peacock at a vastly reduced price. That's according to the CEO, Brian Roberts. The new bundle will be called Stream Saver, and it will be introduced later this month. That's your brief. John.
Danny, thank you. Appreciate it. Up next on the program, setting you up for your day ahead from New York. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upsides.
Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology. This is the count.
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Points to about 472. On a 10-year, we're down 9 basis points to about 435. And as we reprice the yield curve lower, the dollar is weaker against the euro at 108.62, positive by 0.4% on that currency pair. And dollar-yen down to about 155. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have 2 assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice, saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
From New York, for our viewers worldwide, I'm Matt Miller. The countdown to the Open starts right now. coming up on this CPI Wednesday, a downside surprise U.S. inflation report and dropping retail sales. That sends futures higher and yields lower. Plus, memes become nightmares. The retail frenzy reversing course. But we begin with the big issue, which is, of course, signs of slightly slowing inflation.
I think what we've got is a moderate moderation in the U.S. economy, both in terms of growth and inflation. Inflation it's taking its sweet time coming down, but we still think it's a downward trend. And I think the reason for the market reaction is that we didn't get an upside surprise. So we've now had three reports. We've had the jobs report, then we had the consumer sentiment report, and now we've had the retail sales report. And they're all saying, overall things are moderating here.
Joining us now to discuss is PGIM's Robert Tipp. Great day to have you on the program. Robert, what do you think about the slight decrease that we got in inflation? It's still on the rise, right? And it's still far above the Fed's target, but at least it's calming a bit.
Yeah, the big picture on a core basis is that the rate of inflation has come down a lot. Was that touching 7%? It had got down as low as, on a 5-month moving average basis, about 3%. And now it's moved back up. The markets, though, there's always kind of a back and forth of whether the markets have gotten too far ahead. At the beginning of this year, the markets got ahead of that disinflation trend and took the 10-year yield below 4%. As of, a few weeks ago, we were up in the high 4s. The markets have been very disappointed by some very strong CPI stats. So the market is clearly relieved here. But big picture, we are still, as you pointed out, running way above target on inflation. And so I think that's why there's anxiety at the Fed about what's going to be the next move.
Well, at the same time, we have retail sales numbers that are down, in some cases negative. The control group, which I'm going to talk about with Mike McKee in just a moment, 0.3% to the negative. Is stagflation a concern for you?
Not really. I think there is moderation. You see it in employment, and you see it in retail sales. But you have to differentiate that from total consumption. And it's easy to forget when you hear retail sales that doesn't include a lot of services. Consumption, including services, in real terms, has been incredibly solid, has been arguably at an above-trend rate that would have been alarming if sustained. So seeing some moderation to this extent is probably favorable in terms of putting the Fed more at ease that they can cut rates if the inflation numbers cooperate. The question here is, does this qualify as cooperating enough on the inflation side? And I think the answer, as of right now, is no.
On the other hand, markets are still optimistic, right? I mean, we're not at all-time records yet on the S&P, but we're as near as damn it, as the British might say, and we're almost at 40,000 on the Dow Jones Industrial Average. We're looking at a 10% gain for the S&P 500 year to date. The markets are still betting on rate cuts, aren't they?
They are expecting rate cuts, but the equity markets are looking at a solid economy. They're looking at companies that have enough pricing power in aggregate to post 5% earnings gains year over year for the S&P 500. And it is very concentrated, but it is what it is. And this is a solid economy, and interest rates are somewhere in the vicinity of their peak. That's going to be a positive for the economy and for equities going forward. It's also positive for bonds. And so we have an inverted curve. We have too much optimism, even after the increase in rates that we've seen this year, probably too much optimism about rate cuts. But the overall level of yield in the market, when you're looking at high yield, emerging markets, investment grade corporate, structured product, these are really solid yields. And that is what is keeping investors in the market. They want to lock that in for the long term and not get overly consumed with the idea of rolling another set of bills, but potentially missing out on locking in a high rate of income for the long term.
We have some weakness in retail, and I wonder what your faith is in the consumer right now. I mean, Justin Wolfers from University of Michigan this morning was pointing out that wages have beaten inflation since the pandemic. I'm not sure when his time period starts, but he was saying a 24% gain in wages and only a 20% increase in inflation. But he said that the top quintile isn't getting those pay rises. Obviously, they're getting an increase in asset prices if they're in the stock market, but that's probably in a retirement account somewhere and not something they can spend. How do you feel about the U.S. consumer?
Sure. Yeah, I mean, I think there's always, as you hinted at with your quintile comment there, huge dispersion across these quintiles. The bottom quintiles don't have equity exposure and may not have home equity exposure. So they may not be benefiting on the wealth side. You're seeing some increase in delinquencies and, not a particularly strong situation there, except for the fact that the job market is pretty firm. The saving grace for the overall economy, not necessarily from a social perspective, but in terms of the numbers, is that bottom third is not driving most of the consumption. And for the top half, even if the wage gains are not solid in real terms, the wealth position is tremendous relative to income, interest costs. With the increase in equity prices, the increase in home prices, the backdrop is really solid. And so we're seeing that savings rate decline. That's typical when you have wealth gains to see people save less. So I think there's a lot of fuel in the tank here as long as the employment market holds up. I think the immigration is a positive tailwind, as is the friendshoring. So, is there some slowing? Absolutely. But the overall growth picture looks pretty good. And by the numbers, in terms of the consumer, pretty solid as well.
All right, Robert, hang tight for a second. I want to get the take of our chief international economics and policy correspondent, Mike McKee. He's with me here on set. So, Mike, what was your take on the CPI and the retail sales figures that we got this morning?
Well, the CPI numbers were good, Matt. They do show a disinflationary trend maybe reestablishing itself. It came in lower than anticipated at 0.3% for both the headline and the core. The year-over-year numbers drop as well for the first time in 6 months, which is good news for the Fed and its anti-inflation fight, even if it's not a huge drop and we haven't hit the twos yet. There are some things that happened in the CPI that people expected, like housing prices cooled just a little bit, and for the first time in quite some time. Used car prices were down. And then you take a look at auto insurance. This is one of those good news, bad news stories. Auto insurance prices have been a big contributor to CPI, and they were again this time up 1.8%. This is our ECAN feature on the Bloomberg, but that is a little bit less than it had been. So if auto insurance prices are going to start going down, that would be good news for inflation ahead as well. And it was a major contribution to a drop in the Supercore services number, which came in at 0.4% this past month. Now, retail sales is an interesting story. A couple of things you got to notice there. The numbers were all bad across the board there, especially the retail sales core down 0.3%. And they were made worse by the fact that most of these categories were revised lower the previous month. But when you look at what people were actually spending money on, motor vehicles were a big reason that everything dropped in retail sales. People still spending money at places like grocery stores and department stores. So the things you buy regularly, you were still buying. You just weren't buying some of the more expensive or esoteric stuff. Now, there is a drop in internet retailers that is a little bit surprising, but maybe it was because the weather was nice and everybody wanted to go out shopping. But I think, Matt, the bottom line was put out there by Jeffrey Schmidt, who is the new Kansas City Fed Bank president, speaking last night, said whether they lower rates or not will require a data-dependent approach that looks at the data over time rather than loading too much weight on any one release, which is, of course, what the markets are doing right now. David Kelly just said a few minutes ago on surveillance, and I love this line, the Fed has a reaction function. The markets have an overreaction function.
Yeah, I was actually listening to the OG surveillance on Bloomberg Radio, and I mentioned that Justin Wolfer's comment, which is sure to spark a lot of debate about poor rich people. Listen to what he had to say.
Wage gains have gone to those who need them most, to working class Americans, to middle class Americans. And the folks who've missed out, well, they're in this wage bracket, the top fifth, the folks, the chattering classes, the folks who are overrepresented in media, the folks who hang out at the bars and the restaurants and the schools and the playgroups and the local parks that you and I hang out at. They're the ones who aren't doing so well. But the reality is that for most Americans, in fact, real wages are growing quite strongly.
Mike, what do you think about that? I mean, he says you're up 4% if you're a wage earner, but the salaried people are only seeing increases in like 401ks.
Well, wage earners are, as he pointed out, the majority of Americans, and they have been getting wage increases that are higher than inflation. Politically, it hasn't seeped into the confidence numbers yet, which is a problem for Joe Biden. But the wealthy do fine because they're already making a lot of money, so they don't get as big a raises in their salaries, but they are living primarily off earnings from their asset investments, and those have been going up and up and up with the stock market. So the rich are doing just fine, and the slight change in how much they're making in their salaries isn't going to affect what they're going to be able to spend, but it does make a difference to people at the lower ends.
I need to get there. I need to get there. Income
well, you're
off
hanging
just
out
my
at
assets.
the park with
Justin Wolfers.
Justin Wolfers, and you got that, you know, the vest on and everything. Like the guys downtown?
The fleece vest, the hedge fund guy vest. Yeah, no, I don't have one of those. Mike, thanks so much for joining us. Michael McKee there, our chief international economics and policy correspondent. Robert Tipp is still with us. And, you know, Bob, we are seeing continued increases in the equity indexes, approaching 40,000 here on the Dow. As I said, 10% up on the S&P year to date. So asset prices have really been going up. Are financial conditions really as tight as Jay Powell and the Fed would have us believe?
Well, I think for coming back to income quintiles, that's really the theme of the day. You know, at the top of the stack, people are buying homes and buying cars disproportionately all cash with no debt involved. So it's not really binding in some senses for a wide segment of the economy. For the debt-driven consumer, it's hurting. But I think even though you may have income gains there, as of now, it seems like they are having some stress in terms of meeting those payments. So I think at the bottom, they are. But again, in terms of dollar amounts, overall dollar amounts, I don't think they are particularly restrictive. When you look at the corporate side, again, at the bottom of the food chain, when you're in smaller companies, less sophisticated financial officers, all floating rate capital structures, you know, there are problems there. There might be good businesses with bad capital structures that are not able to cope well with this high short-term interest rate environment. So you do have defaults, you know, on the rise in stressed credits. And of course, there are pockets of trouble in commercial real estate like Central Business District, you know, in many places. But it's more pockets. And that's why you're seeing overall favorable performance in terms of equities, but also in the credit markets. And why we may be in this environment where a credit product continues to remain relatively tight, fundamentals are good, and technicals are fantastic. People are coming in recognizing that we're near a peak in the rate cycle, and they want to lock in those yields, and the credit quality is really good enough. So an interesting backdrop here.
Absolutely fascinating stuff. Robert, thanks so much for joining us. Robert Tipp there is the head of global bonds and chief investment strategist over at PGIM Fixed Income. Joining us now with a look at the stock market moves ahead of the opening bell, here's Abigail Doolittle. Abby?
Well, Matt, on that lighter CPI than expected, we do have an overall tailwind for stocks. And it's interesting because we have two big names, Tesla and NVIDIA, both with lots of exposure to China, despite the tariffs that were put in place yesterday by President Biden. Both of these stocks are up solidly. Perhaps some of this CPI tailwind, a piece of that. Take a look at Monday.com, up nearly 20%, soaring as they put up a very strong quarter, beating revenues and analysts extremely positive. almost trading like the meme stocks had been trading, but today, Matt, not so much. If we take a look at AMC, GameStop, and Virgin Galactic, well, we've got declines. GameStop and AMC, as you know, on those Roaring Kitty tweets or posts, had been up more than 100% over the last 2 days, but today giving some of it back, and Virgin Galactic giving back some of its more than 30% gain over the last 2 days. So what goes up must come down.
Yeah, I will point out GameStop, you know, Abby, at $42. 2 weeks ago, it was a $10 stock.
It's unbelievable.
So it has absolutely soared. That should be GameStop Galactic, renaming there. Abigail Doolittle, thanks very much for that. She's going to stick with us. Coming up, China promises a response to President Biden's new tariffs.
For years, the Chinese government has poured state money into Chinese companies across a whole range of industries. When you make tactics like these, you're not competing. It's not competition, it's cheating.
We'll take a look at the tariff tensions brewing next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
For years, the Chinese government has poured state money into Chinese companies across a whole range of industries. Steel and aluminum, semiconductors, electric vehicles, solar panels. The industries of the future. China heavily subsidized all these products, pushing Chinese companies to produce far more than the rest of the world can absorb. When you make tactics like these, you're not competing. It's not competition, it's cheating.
China vowing a response to President Biden's new tariffs. The country's Ministry of Commerce saying, quote, China will take resolute measures to safeguard its own rights and interests. Biden facing a balancing act between playing tough on China without stoking inflation. And oftentimes, very high tariffs do drive inflation higher. Bloomberg's Anne-Marie Horton joins us now here on set. Anne-Marie, what do we know about how much inflation has driven tariffs already? Because that was a Biden concern for the Trump tariffs, which he has left in place and increased.
Well, I think it's hard to get an exact answer from the administration on how much do they view tariffs stoking inflation. We heard from Ambassador Catherine Tai yesterday, the U.S. Trade Representative, speaking to reporters in the press gaggle, and she was talking about that price connection has largely been debunked. When you look at these new tariffs, a lot of them are symbolic. When you look at the likes of electric vehicles, already you don't have massive Chinese companies coming in and sending cars here because of how high the tariffs already were. What you see is the walls going up really as a direction of travel. A lot of people view a lot of this as symbolic. But Matt, whether or not it is Trump or Biden next year in the White House, this is going to be the direction of travel. They are likely going to pull more on levies. Donald Trump is talking about 60% in terms of tariffs he could potentially have on Chinese imports coming to the United States. And this has to do with what U.S. officials will talk about, national security concerns, and also making sure that they can protect United States workers.
Does this mean that, Democrats now agree with Republicans on the protectionist measures that Donald Trump was putting into place? Are we all protectionists now?
At this point, yes. You'd be hard-pressed in Washington, D.C. to find anyone who is not going to want to take a tougher stance when it comes to Beijing.
In terms of the price increase, we're looking at not only 100% plus on cars, and I take your point, right? You don't have BYD bringing cars into the U.S. anyway, even though if they did, you could buy a $10,000 EV. But you have price increases that we just saw on that board for lithium-ion batteries, for solar cells, for all of the kind of things that should make America green. Those prices are going to be higher and higher.
Well, this is what is so sometimes difficult to follow with the administration officials trying to do. What are they leaning on most heavily at what moment? We know that this president wants to be the most pro-climate president in history. He wants to electrify the grid. Well, to do that quicker, that would be, to your point, bringing in these cheap materials, these green materials from China. At the same point, this is a president that also wants to be the most pro-labor union president we have ever seen. To do that, that means shoring up the U.S. base and U.S. companies, and that means making sure you're putting up the walls when it comes to Chinese imports.
That is exactly the point. I think very difficult to be pro-union at the same time as pro-green. He's trying to make it work, and we'll see how that plays out in the election. Anne-Marie Horton, thanks so much for joining us. Bloomberg's surveillance anchor, new surveillance anchor. Great to have you here. Now, some breaking news here. Slovak Prime Minister Robert Fico was taken to a hospital in the town of Handlova after being shot. The Interior Ministry is calling it an assassination attempt. We'll give you more details as they come through. But again, the Slovak premier has been shot in what the Interior Ministry is calling an assassination attempt. Coming up, we're going to give you back to the market, the morning calls, and then later we're going to talk to BlackRock's Gargi Chowdhury, breaking down the latest economic data. Of course, it's been hot today, but also soft. The numbers could mean more gains for the markets, and we're seeing stocks up and yields down. That conversation still ahead. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Horton only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg Bloomberg.com webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Time now for our morning calls. A look at some of the big moves analysts are recommending on Wall Street this morning in a day when we have futures up just about 5 minutes from the open. Morgan Stanley first up, resuming coverage on ExxonMobil with an overweight recommendation, pointing to competitive advantages and a compelling valuation. Next up is JP Morgan, upgrading NEO to neutral, expecting shares to benefit from China's new stimulus measures. And finally, Bernstein, upgrading General Mills to market perform, predicting a stronger second half, given the improving macro environment. Maybe people will eat more cereal, especially if they can't afford anything else at the grocery store. Coming up, BlackRock's Gargi Chowdhury joins us for the opening bell, discussing her outlook for markets and the potential fallout from today's big, slightly littler inflation print. That conversation up next. This is Bloomberg.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
down to the open. I'm Matt Miller, and we are almost there. 30 seconds left. We've got gains of 0.5% here for the S&P and the Dow. We could get to new highs today if we continue to move in this direction. We could see Dow 40,000 if we move a little bit higher. A couple of stocks to watch on the move today. GameStop and AMC down rather than up, although they have gained a considerable amount since this rally started a couple of days ago. GameStop, you can see, is a $41 stock. 2 weeks ago, it was trading for $10. AMC making use of the gains they had seen and swap for some distressed debt, and now the shares drop about 10% in the early trade. Katie Greifeld is here with more on the meme stocks. Katie?
On the meme stocks, let's talk about them because we're taking a little bit of a breather here as you laid out. You take a look at GameStop, you take a look at AMC, both down double digits right now, but that's after an absolutely wild start to the week. AMC in particular, 78% on Monday, 32% yesterday. You take a look at GameStop, it's a very similar story. But as for why we could be taking a breather now, you think about what happened in 2021, there was a big short squeeze, and definitely there was some elements of that going on this week, but the real short squeeze ingredients weren't quite there. GameStop, for example, between 20 to 30% of shares were shorted heading into this week. You compare that to 2021, we were looking at about 140%. Like you mentioned, though, AMC, they did seize this moment. They managed to reach a private deal to swap about $164 million of debt for shares of newly issued stock. Based on the principal exchange and accrued interest, the new stock had a value of $7.33 per share. You think about where AMC was last week, it was trading below $3 per share. Now, it still has around $4.5 billion of debt, but you take a look at the bonds. It's not just the stocks. You take a look at AMC bonds. Their 10% bonds saw a big boost, so AMC at least managed to capitalize on this.
They're not looking to give horse in the mouth. All right, I want to point out, are looking at a new intraday high for the S&P 500. It had been, I think, around 3250, and now we're looking at, 5250, and now we're looking at 5271, 5272. So indeed, we are hitting those highs. Let's look at the Dow Jones Industrial Average, which is conspicuously absent from this list. Right now, 39,745. So getting ever closer to Dow 40,000. Let's get back to another loser in today's trade, or at least it was in the pre-market. Boeing facing potential criminal prosecution after the Justice Department found the company violated a deferred prosecution agreement. Isabel Lee is here with more. Isabel?
Hey, Matt, Boeing shares are indeed facing a little bit pressure right now. So the Justice Department said that Boeing violated a $2.5 billion settlement that allowed the company to avoid criminal prosecution after 2 deadly crashes more than 5 years ago. So now Boeing has around 4 weeks to respond with its analysis and comments, and the Justice Department is still determining whether or how to proceed and whether it will punish the company or not. So the decision increases the legal risks facing Boeing. Remember, after the near catastrophe we had in January when a fuselage panel blew off an Alaska Air mid-flight. So the accident took place around 2 days after the expiration of something called the Deferred Prosecution Agreement. So this is an agreement in which Boeing agreed to comply and cooperate with the government for around 3 years, and if they do so, then the charge would be dismissed. And of course, Boeing said that they believe they honored the terms of that agreement. For now, shares are down 0.4%, but year to date, the stock has tumbled 31%, Matt.
Yeah, it's been a tough time. Conspiracy theories popping up around whistleblowers at Boeing. People are even writing songs about it. So I think it's pretty widespread. Isabel, thanks very much for that. Let's turn to the banks now. New York Community Bank agreeing to sell about $5 billion in mortgage warehouse loans to JP Morgan in order to free up some cash. Abigail Doolittle has more on this deal. Abby?
On this, Matt, we do have the stock up about 1% off of its pre-market highs of when it was up about 3%, but over the last 3 days, or I should say into today, up more than 10%. So perhaps some of this was baked in. Positive news for the beleaguered or previously beleaguered community bank, regional bank, which of course had plunged dramatically on reports earlier this year of the heavy loan load it has relative to some hard parts of commercial real estate. So the idea that they are selling this $5 billion portion of mortgages related to warehouses, seen as a positive, boosting liquidity. Analysts, for the most part, are positive. KBW is saying that it doesn't come as a surprise. Even if it doesn't come as a surprise, Matt, it is a positive, again, just from the standpoint of boosting liquidity. Some of the turnaround plan perhaps going into place, as, of course, Steve Mnuchin had a consortium to back this company, really lifting it off the depths of its March lows. In fact, so much so, Matt, it is now up 130% from that March real nadir low.
Abby, do you think we hit Dow 40,000 today? I mean, the S&P is up 10%. The Dow's only up half as much. Are those 30 stocks going to get some wind behind their backs?
I'd be pretty surprised if that happened, Matt. And for the most part, the Dow has actually been leading the S&P 500 in this recent rally, the string of gains there. So perhaps it is the S&P 500 and the NASDAQ catching up to the Dow. But the fact that you have the S&P 500 above 5,200, I think a lot of market watchers would say that's a technical positive. It needs to stay there, though.
All right, when it happens, we're making hats. When it happens.
Hats with felt.
If it happens, I should say.
Magic marker, sparkles.
Abigail Doolittle, thanks very much. We'll keep her on Dow Watch. Joining us now is Gargi Chuduri. She is Chief Investment and Portfolio Strategist of the Americas over at BlackRock. So it's fantastic to get your perspective, Gargi. Thanks so much for joining us. What do you make of the all-important but slightly softer inflation numbers and definitely softer retail spending that we got at 8:30 today?
Sure. Good morning. It's great to be here. Thank you for having me on your show. So yeah, a really great set of data, I think, for the Fed, especially on the inflation front. So just to speak about the CPI, I think this reiterates what many investors have been hoping and watching for, a step in the right direction. So with a core CPI that it was softer than many had expected, and a headline inflation that was softer than many expected, the details really mattered. And what I paid particular attention to is, you know, all of the areas within goods inflation, such as used and new cars that are slowing down, that are impacted by higher rates. And then most importantly, on services inflation, beginning to see some of that weakness, especially on the rent front, and of course on the super core measures. So overall, one step in the right direction, but certainly not yet enough for the Fed to immediately start moving away from the restrictive territory.
How disappointing. By the way, is this restrictive, Gargi? I mean, your clients are making money hand over fist, right? Asset prices continue to soar. Is that what happens in restrictive Fed policy?
Listen, as we heard from Chair Powell yesterday, based on many, many measures, policy is restrictive. Now, look, there's certain things that policy can control, and there's certain things that policy can't control. For the Fed, it has been very important for them to keep Fed funds at this level. They don't necessarily want to move rates higher because, as we have already seen, there are pockets of the economy that are weakening. There are pockets of income earners that are feeling the stress of higher interest rates, and we don't want that to be the case. I certainly think that interest rates are very much in restrictive territory, and as I said earlier, I think we're beginning to see some of that play out when we see the progress that inflation has already made, especially on certain pockets of goods inflation, and certainly what we're seeing on the services inflation. Is that enough? Not yet. I think we need to see more weakening in the data, especially on shelter inflation, for the Fed to begin to gain confidence and get comfortable in terms of beginning to ease rates in what we think is going to be the fall of this year.
Maybe I mean, forward guidance doesn't feel that restrictive, right? And corporate earnings are still going gangbusters. We have analysts raising earnings estimates after 3 quarters in a row of profit expansion. It seems like everything's still firing on all cylinders. Where's that restriction having the most effect?
I think the restriction is having effect in terms of, you know, how high we saw inflation get to. And today we're sitting at 3.6 on core inflation. So there have been parts of the economy that have begun to slow down. Even if we look at retail sales just today, we're seeing that control number coming in significantly weaker than expected. And if we look at, to your point, if we listen to earnings call and what many of the consumer-focused names transcripts showed, that there is a weakening on the consumer. Now, we have to differentiate between level and change. The level still remains solid. We're not concerned about growth by any measure, but the consumer is slowing down, is softening, and we see that today's in today's retail sales sprint, where outside of apparel, every single category showed a fair amount of weakness. So there is impact of restriction. And when we look at auto loans, when we look at credit card delinquencies, you are beginning to see some of those numbers creep up as well, especially for a certain income cohort. So I think there are restrictions in pockets, and we don't want to make that very restrictive for the entirety of the economy and then lead to a sudden slowdown or a sudden shock. The Fed doesn't want that, and we as investors certainly don't want that. So for now, I think this is the accurate and the appropriate policy in the market. And I think the bond markets and the equity markets are a great place for investors to be, given the income that you're earning in the bond markets and the earnings growth potential that you have in the high quality parts of the equity market.
And as you have pointed out, Gargi, in your notes, the bulk of the earnings growth that we see, I mean, really huge, has come from the Magnificent Seven, right? If you look at the other 493 stocks, we're looking at a drop of 2% year over year. How do you deal with that or how do portfolio managers deal with that?
Yeah, so one of the things that we've been talking about actually since sort of the middle of last year is for investors to focus on two things. Number one, moving to active style of management, so having the tools at their toolkit to move around as appropriate when the macro regime shifts. And number two, we've been talking about investors picking quality in their portfolio, especially in the equity parts of their portfolio. And what we mean by quality is favoring companies that have stable earnings, that have lower debt, and have ample free cash flow. That is what is actually being rewarded in the earnings season. So there's certainly a case to be made that it's not just 6 names or 7 names, that you can look broader for those quality measures, but focusing on the areas of that market that have the ability to keep their margins, that have the ability to grow earnings is going to be really important in a world where interest rates are likely to be here till, at least in our view, September.
Gargi, great to have you on the program. Thanks so much for joining us. Gargi Chowdhury there, coming to us from BlackRock. Coming up, it was all a meme.
There's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression.
Shares of AMC and GameStop reverse course a little in the red after adding $11 billion in market cap this week. That conversation up next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What I worry about it is that it gives investors the perception that all of this is manipulated or none of it is real. And the reality is when you look at the broad market, corporate earnings have been moving up as well with the market. So there's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression.
From memes to nightmares, the meme stock frenzy is cooling off. It's not terribly scary right now, but they're down a bit. GameStop and AMC more than doubled at the start of the week. GameStop is up quadruple since the start of the month. Both stocks on track for their biggest monthly gain since the first half of 2021 when they were on fire. Let's get to our roundtable. Bob Sloan of S3 Partners joins us now alongside Bloomberg's Bailey Lipschultz. And Bob, we'll start with you because, S3 produces the most important sort of pool of short data for the market to look at. And certainly when this first happened, there was a ton of short covering that just put a fire under these stocks. Is that still the case? Is this all about short covering?
We think so. It's definitely shorts cover and reload at a higher level. It's all technically driven. And the real question is, the Kardashians are still here, right? You have to apply that arc to socially mobilized investing. And what Roaring Kitty has done, he has socially mobilized financial publishing, and he has First Amendment rights to do so. This drives financial professionals totally crazy. They don't know how to model it. It's a risk management problem. And, the meme stock community yells about naked shorting and counterfeit shares when short sellers are making money. When short sellers are losing money, they're saying, hey, this is crazy, it's not right, we don't run markets this way. It's a new world. Technicals drive the market. And that's, I think, what David Einhorn was talking about a little while ago. He's saying the flow of money, no matter how it happens, is driving stock prices.
All right, so if Einhorn's on board, does that mean professionals are in this rally, Bailey, or is it still, Wall Street bets? Is this a retail rally?
Well, when I talk to folks who help advise hedge funds, they call out the fact that Wall Street wants to get in on trades. So to say it's strictly retail traders buying the shares, or to Bob's point, shorts covering those positions, when I talk to investors, they really are saying quants are buying it. Momentum traders are getting in and out of some of these trades. When you look at the sell-off we've seen this morning, is that momentum traders realizing that maybe this isn't peak, at least for now, and trying to take some profits off the table? Or to Bob's point, I'd be interested, Bob, if you're expecting to see more short sellers piling into that, is that driving shares lower? When I look at the fundamentals and some of the updates AMC's given with that at the market offering, with their debt for equity swap, is that going to provide more fuel for shorts to take positions now?
Bailey, you're onto something very, very, very important. So what we've done at S3 is that we have solved also for the long side of the market. And we can actually anticipate aggregate buying 45 days before 13F is published. And one of the things we noticed this time around is that quant funds, the quant fund cohort, was actually buying meme stocks well before Roaring Kitty actually published his meme. So they were listening to the sentiment in the marketplace and buying. It wouldn't surprise me if they were part of the rally as well.
I wonder, we get obviously S3 data on the Bloomberg terminal. Can you see the uptake since 2021? I mean, who's buying are using your short selling data?
Well, that would be the world. That's pretty much everybody that's involved in the financing markets and or shorting a stock. There's over almost 750 firms that actually use our data on a daily basis. Here's the point. The average short interest to percentage of float across our entire data set is about 4.68. Right now, you have AMC, GME, roughly 20%. I think GME is 25%. AME is 19%. So they're 4 or 5 times the average. Is that extreme compared to 21? Not really.
What were they then?
Things have changed. Well, they were over 100. We would say there's never anything over 100%, but the rest of the world says it's 150%. So the magnitude is not there. But you take quant fund buying, you take the expensive borrow, you take the 4 or 5 times the average of short interest, and the cost of the borrow going higher. That is a tinderbox waiting for a meme to happen. And that's exactly what happened.
Well, Bob, I want to focus on the cost to short some of these stocks. When we talked about Trump media, the cost of that was astronomical. People really paying over $1 per share of short stake in a weekly span. Is the cost to short GameStop or AMC rising? And how does that compare to what we saw back in 2021?
Well, they're nowhere near 2021 levels, but DJT is at meme stock levels in 2021. I think it's 300%. So let's put that into context for the audience. If I was short $10 of a stock, paying 300% to borrow it, I'd be out of my $10 in 120 days. So the expectation of the marketplace is this stock will go down a lot more than over the next 120 days. Otherwise, you've run out of capital to make your bets.
All right, Bob, great to have you on. Hope we can get you in the studio soon. Bob Sloan there of S3 Partners, joining us with Bloomberg's Bailey Lipschultz, who covers these meme stocks for us. I will say GameStop is now traded limit down, off 25%, and the stock is halted. We'll continue to bring you headlines as we get more out of these meme stocks. For some more of the sector price action this morning, let's go back over to Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, we have the S&P 500 up about 0.4% at an all-time high, potentially busting what some people were talking about as a possible double top, speaking about technicals driving the markets, although we don't know that yet. As for sector composition, it's pretty bullish. Most sectors are higher, led by real estate, utilities, healthcare. Those are the rich, dividend-rich sectors. So the fact that you have yields down lower, those dividends look attractive. Those stocks are higher. Tech creeping up there, up 0.6%. To the downside, energy down 1.1%. In sympathy with oil, down more than 1%. This, of course, is the IEA has cut its 2024 growth forecast. So some investors a little bit bearish on that. Let's dig deeper into the real estate sector, because over the last 3 days, we have gains. In fact, we're looking at up about 2.5% over those last 3 days. The best 3 days in more than a month. This sector has been under some pressure with rising rates ahead of the most recent Fed meeting, Matt. But with yields down today on that cooler than expected CPI print, take a look at real estate popping higher.
Very interesting stuff. Abby, thanks very much. Abigail Doolittle there watching sectors for us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. This is Bloomberg.
face bigger challenges. Britain's next.
Fed was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
All right, just 25 minutes into the trading day, and we are at new record levels, at least intraday records on the S&P 500, 5265 right now, 5266. The NASDAQ right now at 18,375, up about 0.3%, and the Russell 2000, the small caps, which haven't done as well, obviously, as the S&P and the Dow, are doing better today, up about 0.2%. Time now for your trading diary, what you need to be watching this week. Some housing data crossing at the top of the hour to pay attention to. EcoGo is your command on the Bloomberg for that. Fed Vice Chair Michael Barr will be testifying before the House. You can watch that on LiveGo on the terminal. We're going to get earnings from Walmart on Thursday, tomorrow, plus another round of jobless claims. And then finally, we round out the week on Friday with Richemont earnings. What are luxury watch sales doing now? This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings, and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming the video thing live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Big day on the economic data front. We had CPI data, we had retail sales. We're going to break it all down with some really smart people. Lydia Brossour, senior economist at Ernst & Young, will give us her thoughts on the CPI print. Mari Shore, one of the folks we like to really talk to about all things retail. She's the senior equity analyst at Columbia Threadneedle Investment. She's going to join us to break down the U.S. retail sales data that came in a little weaker than expected. Maybe get a little preview of Walmart tomorrow. So a lot's happening here in the next couple of hours. Right now, let's kick it all off with Mr. John Tucker.
All right, record watch today, surpassing records for the S&P 500, the NASDAQ, and the NASDAQ 100. And the fuel for this push higher in the data, the Fed rate cuts more in focus. We got retail sales. They showed slowing. The consumer price index showed inflationary pressures easing. David Kelly at JP Morgan Asset Management reacting to the latest economic numbers.
Well, I think what we've got is a moderate moderation in the U.S. economy, both in terms of growth and inflation. Inflation it's taking its sweet time coming down, but we still think it's a downward trend.
And right now, 9 of the 11 major industry groups in the S&P 500 being led higher by real estate, utilities, and information technology. That's an odd mix. Ahead of the earnings tomorrow, shares of Walmart right now, they've just turned higher, just fractionally, about up 0.1% right now. Overall, the S&P 500, 23 points higher. That's up 0.4%, 52.69. Dow Jones Industrial Average up 143 points. That's up 0.4%, 39,703. The record there would be 39,807. And the NASDAQ 100, 80 points higher. That's up 0.4%, 18,402. Now to the yields. The 2-year, 6 basis points lower. That's at 475. The 10-year. That's 6 basis points lower. That is at 438 after the data. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Hello.
Hello.
So nice to see you both. Happy Wednesday. Happy hump day. Once we get through today, it'll be better.
Yes, what'd you make of it? The economic data. The market seems to like it.
My impression is that people just want to buy stocks.
Okay.
And they just want to buy bonds. And sure, you can make the narrative of, okay, this means that you have a slowing retail sales, so therefore the Fed can actually cut. But we're just pricing in barely 2 cuts. It's not like this moved the needle in a massive way. I think people just are risk on. They just want to buy. This is a green light for risk. Go buy all the things.
Gina Martin Adams said kind of the same thing. It just sounded a little bit more technical.
Oh, for sure. Yeah, right. Right on.
But she said basically the same thing. She said people just want to buy stocks here. But again, and Gina said the retail sales miss, if you will, or disappointment. Again, it came in at a negative 0.3% versus a consensus positive 0.1%. So that miss, if you will, no big deal.
Exactly.
Can I just say we're brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. And I don't know that they're having any exotic conferences anytime soon.
Okay, we're going to have to...
We've been promoting this Interactive Brokers thingamajiggy, or where is it? Which one we're doing?
The Nashville one?
Yeah, the BNY Mellon Insight.
Yeah.
Oh, boy.
The one I'm not going to.
Correct, yes. Here's the other thing, if we just go on sort of the equity rally, is this is why I feel like people just want to buy stuff, because meme stocks, right? I understand that we had the roaring kitty and the thing, and he moved forward in the chair, and he tweeted on that, yada, yada. But it's now a little bit more broad-based. Like, you have GameStop, you have AMC, SunPower, Virgin Galactic is up, Plug Power was having a short covering rally yesterday. There was news, but still. And if that happens, it doesn't really feel like financial conditions are too tight. But anyway.
Speaking of GameStop, we have a trading halted. I'm not sure if it opened today. But anyway, yeah, I think I don't know, it's down 27%. But we'll see. I don't know. Trading halted for GameStop. Who knows? All right, let's go right to the person who does all this stuff. Carmen Reineke. She covers all the equities for Bloomberg News. Joins us here in our studio. Carmen, what are you looking at?
Yeah, so as you were saying, the meme stocks, they're the big thing that we're all watching this morning. Obviously, we have AMC and GameStop down both huge. AMC is down about 20%, GameStop 28%. But there are a lot of other stocks that are also moving on this that had huge runs up in the last few days. One that I was looking at, Tupperware, really sort of a blast from the past. It was up a ton. It's down 16% right now. As you said, Virgin Galactic, ticker SPCE, down 12%. SunPower, down 31% after rallying almost 100%, more than 90. This one was interesting because it also had a downgrade today. And the analyst said basically the stock needs to come back to reality after this short squeeze, and there's been no recent positive developments at the company that would account for the huge spike. So I think you're right. Like, people are wanting to buy. They like getting caught up in these sort of frenzies, and then we see it on the other side that there's a lot of volatility.
You're also looking at Monday.com. What is that?
It's interesting. It's a workplace management platform. It sort of has all the things where you can do like your marketing and track your progress on the things that you're working on. It's an earnings story. So shares are up about 21% right now. The application company reported first quarter revenue that beat expectations. Bloomberg Intelligence said that it shows strong momentum. It had a lot of good customer additions and a solid upward revision to the full year outlook. So I think this really plays into a trend that we've seen all earnings season, which is the last quarter matters, but that guidance is the most important piece of the puzzle. So saying that you're going to have strong sales going forward, that you see positive developments coming for the rest of the year is what investors want to see. So shares are up a lot on that.
I've never heard of this company before.
neither.
I've never heard. It's an Israeli company. BI does cover it, and I'm just looking at the stock. It's an Israeli-based company, as I said. $10.8 billion market cap company, up 17% year to date, which is all today, I guess. With
Pretty much, yeah.
21% move in there. Okay, interesting. It's a software company.
Well, here's another one that you have is Arcutis. Am I saying that right? It's a biotech company, and that's having a nice day, up 13%. What's going on there?
Yeah, so it's also an earnings story here. Sales for it. So it has this one medication. I do not know if I'm pronouncing this correctly. Zorive.
We definitely don't know. So
yeah,
I'm sure that sounds great.
It's a skin condition. It's a medication for skin conditions. Basically, sales beat consensus, and analysts were impressed by that. There is also some sort of like positive developments in the pipeline for that drug. The Prescription Drug User-Free Act date for it is coming up, on track for July 7th. This is a positive milestone, according to Morgan Stanley. So basically, it's just, this drug is doing really well. The pipeline's looking good. And yeah, investors are happy about it. Shares are up 13% right now.
I'm just looking at Walmart just to get a sense here. The stock's pretty much unchanged today. Not really much happened, but they're going to report earnings before the open tomorrow. It's up about 14% year to date, but given this retail sales print, I really want to hear what Walmart has to say about what they're seeing in their aisles.
And what we've seen, I think, is really positive moves for certain stocks, and I feel like it's with all consumer discretionary names, even like fast food, that have a very specialized kind of product. Like On, the sneaker company the other day, like that yesterday, had a huge move higher. It's very like a niche kind of thing, and I wonder how that's going to translate or not into a behemoth like Walmart. I appreciate that they have the food part, and that's very important, but I wonder how that will translate.
Well, we've also seen, I think it was maybe Papa John's that said that they were seeing a shift in sort of like the lower end consumer and what they were paying and how much they were ordering. So I think that's also something I'm always watching on Walmart. Like, are they seeing a difference in sort of that income bracket?
Yeah, Starbucks said that. Amazon was warning of that. McDonald's said stuff like that. So it should be interesting.
Brand loyalty, which I didn't think about it until recently.
Okay.
Sneakers.
Really?
Someone is trying to get me to switch brands.
This is Matt Miller, right?
No.
Oh, okay.
No. Someone who actually would listen to.
It's also a fair point.
What is your current loyalty?
Nike.
Okay.
So why do you think you have the brand loyalty?
I don't know. It's just one of those things. Budweiser's in cans, Nike sneaks.
Huh.
Kind of.
It's a simple
Other than that, I can be
classy guy.
Exactly. Other than that, I can be bought. All right, very good. Carmen Reineke, thank you so much. We appreciate it. Carmen, she covers all the equities for Bloomberg News here. Let's get to some of that economic data here today. Lydia Bussour joins us. She's a senior economist at Ernst & Young. She joins us from New York City via that Zoom thing. So, Lydia, looks like that inflation scare that we had maybe the first 3-4 months of this year is maybe moderating a little bit. Is that the takeaway from the CPI data that you looked at today?
Yeah, sure. I mean, I think the key takeaway is really that inflation continues to move in the right direction, and that disinflation trend remains in place despite the bumpiness that we had in the first quarter. I think the details of the report this morning were encouraging, both on the goods and services side. We saw that cooling in core inflation, core goods prices declined in April, and that really indicates that this more favorable and normalized supply chain environment continues to be conducive of deflation in the goods sector. And on the services side, we also saw an easing in the pace of inflation, with many of the categories also showing some cooling. So overall, that's a report that suggests that we're still moving in the right direction.
Something I'm still grappling with is why the Fed has such conviction that financial conditions are tight. When you take a look at meme stocks, when you take a look at the actual financial conditions index, do these numbers justify that confidence or no?
When you look at the economy overall and the package of economy data that we got this morning, you mentioned retail sales earlier on the show. Retail sales were quite soft, and they do suggest that consumers are increasingly cautious with their spending. We have an economic environment that's cooling, the labor market is rebalancing, wages are moderating, and at the same time, we have, today some evidence that we remain and we continue to see that disinflation happening, especially on the core side. So the progress has been slower, but overall, the economy continues to cool, and inflation is likely to continue to gradually ease, throughout the 2024 and towards 2025. I think what will be important, what's important to keep in mind is that we may hit a plateau when it comes to inflation, CPI inflation, in the coming months. But overall, I think the report today has helped rebuild a bit of confidence that the Fed had lost in the first quarter of the year.
Lydia, we also yesterday had a little bit higher than expected PPI print. How do you kind of put that in the CPI data we got today? How do you put that together? What's the narrative there?
Yeah, I mean, looking at the PPI data, I think some of the details were more encouraging, especially looking at some of the key categories that would feed into the PCE data. So looking at, some of the underlying components of PPI. But overall, I think, when we look at the overall trend in inflation and what that means also looking at these two reports for PCE inflation, I think that we're likely to get, a fairly encouraging print on the core PCE data, and that overall core PCE inflation should continue to gradually ease in the coming months. I think, we're coming off of that first quarter where inflation has surprised on the upside, for several months. And what we need to see going forward is really softer inflation print, a string of softer inflation print that will help the Fed feel more confident that, they're in a good spot and can start, that easing cycle.
Do you think the easing cycle will be 2 cuts this year, 1, and then what?
Yeah, so we have, our view is that we're going to get 2 cuts in the second half of this year. We do think that, as I said, the economic environment will be favorable for those 2 rate cuts. And when you think back at what Fed Chair Powell said at the press conference, he really laid out 3 paths when it comes to monetary policy going forward. And there are 2 of these paths that are leading to rate cuts. If you see a deterioration in labor market conditions, or if you see inflation moving sustainably towards 2%. Our view is that, the economy is going to continue to cool, and that conditions are in place to continue to see that disinflation. We have an economy that's cooling and consumers that are growing increasingly cautious. We have a labor market that's rebalancing and wages that are easing. We also have signs that companies are exercising less pricing power, and we're likely to see more downward pressure on profit margins as well. And lastly, we also have more rent disinflation in the pipeline, and the numbers this morning were also encouraging in that front, where we continue to see that downtrend in rent inflation. So overall, I do think that, this backdrop is going to lead the Fed to start that easing cycle mid-year, and we see 2 rate cuts happening. So more of a recalibration than an aggressive, rate cut cycle.
So we also had retail sales came in a little bit weaker than expected. What's your read across there?
Yeah, so the retail sales report, weaker than expected. Looking at some of the details, it was quite mixed. I think there was some categories where we saw some payback. Looking at online sales, for example, they were very strong in March, so they declined in April. And overall, I think what this suggests is that consumer spending momentum at the start of Q2 is going to be looking softer. We came out of March with significant momentum when it comes to consumer spending, and you have that robust carryover that's supporting positive consumer spending. But what it does suggest is that on a month-over-month basis, we've seen somewhat of a downshift, and we think that this is a trend that will continue because consumers are feeling, the impact of elevated prices, higher borrowing costs, and just, a more challenging environment, especially for lower-income households.
All right, Lydia, thanks so much. We really appreciate your time today. Thank you so much, Lydia Boussour, EY Pantheon Senior Economist. We very much thank you for your time. Speaking of retail, I was really struck by those Burberry numbers. Now, luxury has been...
Burberry?
Yeah, luxury has been... Certain areas of luxury have been struggling, and Burberry kind of doubled down on that. They had sort of weaker sales, and their outlook wasn't that great for the first half either. So even the high end continues to kind of get dragged down a little bit, which also you find to be a bit confusing.
Well, whenever I think of retail, luxury retail, I think of the Chinese consumer as kind of the swing factor. I wonder what they're saying about the Chinese consumer.
It's always about China, but also pockets of weakness in the U.S. As well. So it's not just a China situation when it comes to retail. I'm trying to pull up the
stocks down about 5% here today.
Yep, weak demand China and U.S.
Yeah, so I mean, it's it's out there. It's concerning, but I mean, I guess the overall economic data is still generally pretty solid, I guess, and is it solid enough for the Fed to start pulling back on rates, and if so, when? So that'll be interesting.
And it's still, what I find so interesting, it's still the hard and soft data. The soft data, I appreciate NFIB was a bit better yesterday, but the feelings are negative, even if the hard data is a little bit positive or at least stable. Particularly if you take a look at how many people are benefiting from the equity rally. Right. And there was a great, in John Arthur's piece, he really helped break it down. Oh no, it was Lu Wang had a piece where she broke it down and said just X amount of people have money in the stock market that are benefiting, and guess what? They're mostly older white people, and everything else is a bit dicier. It was a great piece. You should definitely check it out. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash. Right now, on course for record close for the S&P 500, for the NASDAQ and the NASDAQ 100. Stocks higher, bond yields pushing lower after retail sales slowed. Also, the consumer price index showed the rate of inflation slowing. Fed rate cut or more seems to be likely. As shares of the meme stock favorites, GameStop, AMC, Entertainment, they are plunging right now. Shares of GameStop 32% lower. AMC Entertainment down 26.5% right now. And ahead of their earnings tomorrow, shares of Walmart pretty much unchanged. S&P 500, 29 points higher. That's up 0.6%. We're at 52.75 on the index. The Dow Jones Industrial Average up 142 points. That's a rise of 0.4%. The NASDAQ 100 right now, 111 points higher, 0.6% higher. Two-year yield, 6 basis points lower, that's at 4.75, and the 10-year also 6 basis points lower, that's at 4.37. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business and economics through our lens of our Bloomberg Intelligence analysts. They cover about 2,000 companies and 130 industries worldwide. We also sometimes take you outside the Bloomberg Intelligence world to those that work on the street. And for that, we're going to go to Mari Shore. She covers senior equity analyst over at Columbia Threadneedle Investments. They have a great team over there. We love talking to these guys. Let's get breakdown after retail sales. Thanks for joining us, Mari. It's great to see you.
Thank you so much for having me.
So break down two things. One, where in the retail world makes sense? And two, do equities at record highs make sense?
Yes, it's a great question. I think, when we look at the retail sales print today, I think we see more of what we've been discussing, which is still a choiceful consumer, still spending more on services over goods and needs over wants. So overall, my outlook for spend on more discretionary goods is more cautious. We still see things like home and electronics really weak. Versus strength in certain channels like e-commerce and value retail, and in certain categories. Like I thought today in the retail sales print, the improvement we saw in apparel was interesting, and we've seen some new trends in apparel, and it seems that some of the traditional apparel companies are taking share back maybe from some of the athletic apparel companies. So that's, I think, an interesting trend to watch. In terms of the valuations on some of these names, it definitely seemed like the group was a little overextended in the earlier part of the spring following the rally that started in October. And now I think you really need to be selective. So I would say we're still willing to pay a premium for consistent quality growth that we see in names like Walmart and the off-price retailers, which are all gaining share right now. I think, given the relatively weak demand backdrop, we are willing to pay more of a premium for those retailers that are taking share.
All right. Usually we chat with you via Zoom, so
yes,
it's nice
correct.
to have you in our studio. You show up in Boston, right?
Yes.
Yes. Okay. Very good. Coming down to the big town. Okay. Mari Shore, you cover the equity space for Columbia Threadneedle. We got Walmart tomorrow, and people who like me who don't follow the retail space, I look to that name as kind of a barometer for how the U.S. consumer's doing. What are you going to be looking for tomorrow?
Well, I think we're likely to hear from Walmart still a more subdued tone on the consumer overall. Their core lower income customer is still under pressure. They are, however, taking share across category among higher income consumers. And that's been something they've been talking about for several quarters now. So I think that says a lot about the overall consumer and how they're looking to save money.
Are they taking share from them like Target and stuff like that?
I think they are, yes. Across category, you really see it from Target and others. And I think that consumers are really looking to stock up you know, and do that one-stop shop at value retailers. You know, you see it at Walmart, you see it at Costco, right? Their results have also been extremely strong. So I think that the results from Walmart tomorrow will show us what's happening from a macro level. But again, I want to be mindful that any strength that Walmart does show, I think is likely to reflect not just what's happening at the category level, but what's happening in terms of their share position within categories.
So how about the dollar stores? What happens to the dollar stores when the lower end of the economic environment is in fact struggling? They are dealing with inflation. Does that benefit their business, or does that hurt them even more?
Yeah, it's sort of mixed. I would say it does hurt their core lower income consumer, and you've seen all the dollar stores talking about weakness in their discretionary business among that consumer cohort. However, there is the potential for them to capture that trade down from a higher income consumer. And so that is an opportunity, I think, for the dollar stores, for off-price retailers like Burlington and Ross stores. Yeah. But again, I feel like Walmart has really been the name among those value players that has captured the most share from that higher income consumer.
Also, some of the dollar stores are just a disaster in terms of like shelf stocking, in terms of employees. Like it's a real mess. Like it might be good to get a deal, but only if you actually find a product. John Tucker, why are you laughing at me?
The one next to me, and I loved it, just they closed up. I walked in one day and it was gone. It was just like, what happened? Like overnight.
And
they
crazy.
only had one employee in a pretty large store, and it was just like, oh, you want to steal some?
Pretty much go ahead. Like that, we can't do anything about that. So I don't know if you guys know, if we've talked about this, that I am the counter indicator for retail.
Right.
So Mari, so here's the deal. So I only shop on sale, period. I will not ever pay full price. So usually where I'm shopping, the joke is that I'm an indicator for what stock you want to short, because I'm only going there because the deal is really good. That's an inventory thing. So I definitely went over budget this weekend. I went to Nordstrom Rack, but I was buying work clothes, so I felt okay about it. Am I an outlier here? Like, are the discounters gonna win, or are they gonna lose? And how much will I be spending for the rest of the year?
Yeah, no, I think, and again, we saw it in the retail sales data today in the strength in the general merchandise category. I think all of these value retailers, whether it's the mass players, the off-pricers, the dollar stores, the clubs, they will all continue to take share in this environment. In terms of the, in the hunt for deals, I would say I would expect more modest deals going forward, only because, last year we saw inventory much better controlled, much more closely aligned with sales, and all of the retailers are really focused on protecting margin. So I think you will see lower markdowns going forward. Of course, the retailers will always use promotions to drive traffic, but in terms of those major markdowns that you may be looking for.
I'm like a 75% kind of girl.
Yeah.
Like, I don't do the 10,
Probably
20.
won't see as many of those going forward.
That's definitely going to hurt a little bit there. Yeah, we went to, this is anecdotal, obviously. Went to TJ Maxx, which is usually my go-to store. Inventory was horrific. There was nothing. That was really surprising, and I wondered if they're waiting for a cycle to come back, or if they're just really good at getting stuff off their shelves.
Interesting. How about, I'm just asking for John Tucker here, the luxury sector. Alex and I were just talking about Burberry, some disappointing numbers. I thought luxury was kind of a relatively area of strength for retail.
Yeah, I mean, I would say over the past year or so, we've really seen a slowdown among, I would say, both the true luxury segment and that more aspirational luxury segment.
More Ryan.
Yeah, and I think it really reflects, those consumers now spending again on things like services and travel. And so we've seen, there's not a lot of public retailers at this point in the true luxury segment in North America, but we've definitely seen a slowdown really globally, across China, Europe. And I think it's that customer spending in other categories, and also some of those brands that do have exposure to the wholesale channel, where, all of the department stores still managing inventory very tightly. So if you're selling into that channel, you may also see pressure on
Burberry
your orders.
Is in that business, and they did call that out.
That so I think it's really a combination of those two things. I think long-term, luxury is still well-positioned, but we're still kind of coming off of this period of, excessive growth that we saw during the pandemic and watching demand normalize.
I don't know, man. $2,600 for a raincoat? Please.
Well, what kind of raincoat?
A Burberry raincoat.
Well,
like that. I appreciate that's aspirational, but hell no. That just feels like a waste of money. But
don't you have some budget for clothes?
Oh, yeah. So like I give myself a budget of.
No, I mean, doesn't Bloomberg clothe you?
Oh yeah, but not a trench coat.
Oh, okay.
And that definitely would not be in the budget.
Wait a second.
For that.
What?
They have a budget for wardrobe.
Again, another benefit I don't realize.
Another benefit
Yeah.
you don't have.
I
No
mean-
makeup, no.
They don't send me to travel.
They
They
don't-
don't buy clothes
Okay,
for
A,
me. No
we would
makeup.
put makeup on you. You don't let them be, I don't know. Yeah, downstairs is a wardrobe room. We get our clothes picked and everything.
Really? I didn't know that.
Yeah,
Okay.
they don't shop on sale, but, I do.
All right, Mari Shore, thanks so much for joining us. Mari Shore, senior equity analyst. She covers all the retail space, one of our go-to voices for retail. She's at Columbia Threadneedle Investments. They're all over the place. I first hit Threadneedle, they're in London. Then there's been all these mergers with the asset managers, and now it's all under like Columbia's.
And they're good. Like, they got some serious talent there.
They do.
Yeah.
They're good up in Boston. But she joins us here in our Bloomberg Interactive Broker Studio. Maybe she's walking up and down Fifth Avenue and Madison Avenue, kind of checking out the stores. That would be my guess.
Let me know where the sales are.
Yeah, exactly. All right, S&P 500 up 0.6%. The NASDAQ up the same. So we have a nice little lift here. Yields coming in. 10-year Treasury off about 7 bips to, let's call it 4.37%. So yields coming in. And Bitcoin for Tom Keene, I'll give that Tom Keene quote there, 64,400 up 4.6%. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, and John. President Joe Biden says he won't participate in campaign debates sponsored by a nonpartisan commission, instead challenging Republican Donald Trump to a pair of debates in June and September. Biden released an online video on his X account, formerly Twitter.
Donald Trump lost 2 debates to me in 2020. And since then, he hadn't shown up for debate. Now he's acting like he wants to debate me again. Well, make my day, pal. I'll even do it twice. So let's pick the dates, Donald. I hear you're free on Wednesdays.
The free on Wednesdays comment was a dig at Trump's ongoing hush money trial by noting that it's Trump's usual day off in the trial. Trump tells Fox News Biden's proposed dates are fully acceptable to him. Secretary of State Blinken announced a $2 billion arms deal for Ukraine. It's mostly from a package approved last month. It comes as Ukrainian President Volodymyr Zelensky canceled all of his foreign trips over the coming days as his commander-in-chief visited Kharkiv. Russia launched a large-scale assault on the region for the first time since 2022. There's word Slovakia's populist Prime Minister Robert Fico has been injured in a shooting and taken to a hospital. The attempted assassination took place in the town of Handlova, northeast of the capital. Jimmy Carter's grandson says the former president's health remains status quo. Jason Carter spoke at the 28th annual Rosalind Carter Georgia Mental Health Forum in Atlanta. He talked to WSB on the sidelines of the event, saying his grandfather is at the end of his life.
He knows he's not in charge of this process, and so he is embracing that as much as he can, embracing these days as much as he can, and I think he's doing good.
Carter is 99 and has been at home hospice since February of 2023. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
connection lost.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the newsroom with this Bloomberg Business Flash. Several of the major stock averages on track to set records. Retail sales, they stagnated in April, the weakest showing in 4 months. Consumer Price Index showing the rate of inflation slowing. These are all Fed-friendly data. And George Congalvis at MFUG Securities sees signs of weakness in the economy.
And I think that, we're seeing layoffs too, right? I mean, actual physical layoffs. So I do think the cracks are there. And this is why I've been more of a dovish leaning that the Fed should be prophylactic and get ahead of the curve and start to actually cut. I mean, I'm probably one of the standouts with like a July cut, but I think a lot can change in the next 2 months.
Walmart shares ahead of their earnings, pretty much unchanged right now. Dow up 192 points, S&P 500 up 35 points, and the NASDAQ 100 right now up 141 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so you can go to youtube.com and search Bloomberg Podcast, and that's where you'll find us. All right, let's turn now to a conversation on artificial intelligence. Last Thursday, I attended the Boston Consulting Group Edge Expo in Boston. I had a lot of great conversations with the execs at BCG. One was with North America Chair Sharon Marshall. She speaks with CEOs daily about what they are dealing with their own company. One big issue that keeps coming up, Sharon said, was AI. I began by asking her what questions she's being asked most by CEOs. Let's take a listen.
I speak to CEOs on a daily basis, and I think the good news is there's cautious optimism. If you speak to most CEOs, they see a very, very strong potential. Some say infinite potential in terms of AI.
Yep.
Obviously, the economy is here in North America is performing very well and creates more stability in terms of capital investment. And I think the unknown is about the geopolitics and our current political environment and how that will all play out. But, in speaking to them, cautious optimism, thinking about AI, how do I scale it? How do I get value out of it? And how do I fund the journey? So looking for opportunities for cost efficiencies.
Well, let's go to that AI, because that's been a topic here today. A lot of smart people we've spoken to from BCG about the AI business, about the ethics of AI, which is something folks really need to think about. But the bottom line is it requires, from my understanding, a lot of investment and over a long period of time, a real commitment here. When you talk to CEOs, do they get that, and are they willing to make that commitment?
So, Paul, if you click back a year, we were doing a lot of conversations with boards and with CEOs, and there was a lot of experimentation that was going on, but it really it was just experimentation. It was use cases, and I think people were learning a lot. Now you flash forward a year, and I think companies and CEOs are thinking, how can I create competitive advantage using AI? And what are the areas I'm going to pick to invest in? Because you can't invest it would be cost prohibitive to pick everything.
Yep.
And so what's interesting is you see some companies are picking what you would consider more strategic aspects of their business. So if you think about insurance, either claims processing or underwriting, core processes which are strategic to really lean into and invest. Some other companies actually have chosen more of a back office route. So really thinking about customer service, how can AI fundamentally transform how we do customer service to make it better and more efficient? So companies are on different journeys. It's going to be expensive, and they have to pick the places which is going to pan out for them and give them real advantage in the marketplace.
And on the people side of the equation, there's concern out there in the marketplace about AI will take jobs. Or if it doesn't take jobs, it's going to require a tremendous amount of retraining. How do the CEOs think about that? Are they concerned about that? Are they willing to make those investments in their people?
I think that's exactly right. So AI is going to change a few things beyond the technology. It's going to change, in many cases, actually organization structure. It's going to change process, end-to-end process, and also skills required. We often talk about the 10, 20, 70,
yep.
and the 70% of the change is going to be people and change management. If you speak to CEOs, I think they feel like it is worth it. It has to be done in order to stay at the head of the curve and to provide competitive advantage. But again, being choiceful in where you choose to scale, because you can't change everything all at once.
I was mentioning to my young producer that as one ages, one has to really make the commitment to embrace change and be open to change. I'm case in point. When you go talk to the boards and to the CEOs, is it a tough sell to say, hey, AI, this is an inflection point in what you've traditionally understood to be your tech spend?
I think they understand it. I think they're not as familiar with the technology, but they're pushing themselves to get there, because you're absolutely right. I mean, look, if we look at our own data within BCG, the greatest adoption is with our less tenured people, and the adoption there is very, very high. But I think all of our partners, our most senior people, as well as the CEOs and the board members, realize that they have to get the comfort level and upskill themselves in order to be relevant in the future.
Are there some industries that are maybe doing a better job of kind of leaning into this AI and what it really means in the long term versus some others?
Know if it's versus some others. I mean, we're seeing a lot of activity, a lot of interest across all of our major sectors. So really thinking about healthcare as an example. So drug research would be an example, or medical records writing. So there's a lot in the regulatory sphere that can be improved through AI. If you think about insurance, there's an enormous amount of documentation and review. And so in specific areas within each industry and within each sector where there's a lot of documentation, review, those are the areas that are being focused on.
All right. Speaking to CEOs, you have to talk about, particularly for your global clients, I would think geopolitics, for better or worse, is at the top of their list or on their to-do list. And you think about what's happening in Ukraine, the Middle East, and you can never take your eye off Taiwan and Asia. Can you plan for it? This is a little bit different world than we had 4 or 5 years ago.
It's interesting. We did more work exactly on that topic last year than we're doing this year. I feel like there was a lot of preparedness and scenario analysis that was done last year. It's continuing to be done and updated. I think many companies are on that journey. And actually, our recent CEO survey showed that 63% actually felt much better prepared for a geopolitical event at this time this year versus last year.
All right. How about BCG in particular? I was thinking way back to my days at the Fuqua School of Business at Duke, meeting with all the consulting companies. A couple things that I remember. They paid pretty well, but they worked pretty hard. They travel quite a lot. How has your business changed since the pandemic, maybe with the advent of some new technologies?
Great question. So Look, it's super important that we travel and that we spend time with clients and at sites. I think the pandemic has also, just like many industries, given us a little bit more flexibility. I think our clients are sometimes very happy to meet with us on video, and we do that quite a bit as well. And, of course, like any responsible business, we are trying to lower our carbon footprint. So it's something, as we think about, for example, internal travel, that we really try to manage. So I think it's better than when I joined BCG, but it's still a pretty demanding job.
All right, that was Sharon Marshall. She is the North America chair for BCG. I was chatting with her last week at a conference up in Boston. And, her job is basically just to take phone calls and field phone calls from CEOs, their clients, and try to help them with their problems. And she says, boy, it's like every single call is about AI, the types of investments that their clients should be making in AI, how they should be making those investments. How do you weave the whole ethics thing into this whole AI discussion? But it's certainly top of mind for her and her, all the other consultants up there.
Does BCG feel like they're behind that curve or on top of it? Because just as it's their clients are panicking, I would assume that they don't have all the answers either.
No, they don't. But they have a lot of people there that are spending a lot of time on it, and and the people I spoke to there at BCG were, seemed very well read in, but acknowledged, like you said, way early in the game. But I think one of the key takeaways I had was you have to put the whole ethics of it first before you spend $1, which doesn't usually happen because usually people are spending on the tech, But you really have to think about how you as an institution, as a company, want to frame this investment in terms of the ethical applications of AI. You have to have a really strong call on that before you put the shovel in the ground. So that's kind of how they begin the discussion with their clients. But again, big dollars being spent, big commitments, that's for sure. A lot more coming up. This is Bloomberg.
headlines on Bloomberg Radio.
And I'm John Tucker with a look at some of the company news. Remember those stupid Google, well, that's editorial, the Google glasses. Remember those?
No, but that probably says a lot.
What do you mean you don't? Oh, anyway. The augmented reality headset, they flopped with consumers a decade ago. Poised for a revival thanks to artificial intelligence. Alphabet's Google is struggling for years to get AR spectacles to work. After the initial headset was phased out in 2015, the company sold enterprise versions for businesses. Those two were discontinued last year. Now the executives are signaling new AI features could set the stage for the AR glasses to return. This from the Journal. You can find Paul there a lot. Red Lobster expected to file for bankruptcy as early as next week. The casual dining chain seeks to cut its debt load. Known for its cheddar biscuits and popcorn shrimp, Red Lobster recently closed dozens of its roughly 650 U.S. locations. Restaurant chains are struggling, of course, with declining customer traffic. Consumers, especially the low-income diners, are pulling back on spending. All-you-can-eat shrimp deal that executives hope would turn the chain around contributed to millions of dollars in losses. Bruce Springsteen joining the list of artists producing TV shows for Walt Disney's streaming platforms. Road Diary, Bruce Springsteen and the E Street Band, a documentary about the singer's recent world tour. It's going to appear in October on Disney Plus and Hulu. The company said this in a presentation for advertisers in New York. This is going to show Springsteen and the band rehearsing in Red Bank, New Jersey. I guess that would be the Count Basie Theater, right?
Yes, I think so. That's where I would
Where else would it be? And choosing the songs for their 3-hour shows. And that is a look at your company news. I'm John Tucker.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. Happy middle of the week. Happy hump day. I'm Alex Steele alongside Paul Sweeney. We are live from Interactive Broker Studio right here in Midtown Manhattan. We bring you all the top financial and business news that you need to know every day. We also bring you world and national news. And for that, we welcome Michael Barr. Michael?
Thank you very much, Alex, Paul, John. Joe Biden's presidential campaign is proposing to debate opponent Donald Trump twice starting in late June. The president is refusing to participate in debates sanctioned by the Commission on Presidential Debates that has sponsored them for 3 decades. Biden's campaign chairperson said that the president will not participate in forums scheduled for mid-September and early October. Jen O'Malley Dillon says the dates are too late because they will occur after early voting begins in many states. A competitive Senate race is set in Maryland. Democratic County Executive Angela Alsobrooks will face Republican former Governor Larry Hogan after she defeated wealthy Congressman David Trone in yesterday's primary. Alsobrooks defeated Trone 54 to 41%. Hogan got 62% of the GOP primary vote. Bloomberg Government's Jonathan Tamori.
That's not the kind of state that you would normally think of as having a big Senate race, considering how Democratic it is, considering they haven't had a Republican senator in over 30 years. But they've got an unusual Republican candidate there, Governor Hogan, who won 2 terms there as a Republican, is now the Senate nominee. And Republicans think that he can put this state in play, or at the very least, make Democrats spend some money there that they might prefer to spend in some other states like Montana or Ohio, which are typically tougher battlegrounds.
Government's Jonathan Tamari, Bloomberg in Washington. Police have arrested the driver of a pickup truck after a deadly bus crash in Central Florida. Brian McLean Howard is accused of sideswiping a bus full of farm workers in Ocala, killing 8 people and injuring another 45. He is accused of driving under the influence. Britain's new king has unveiled his first official portrait at Buckingham Palace as monarch, but it's getting mixed reviews. Some royal watchers say the 8-foot-tall painting makes 75-year-old King Charles look like he's in hell, with all but his face and hands in a pinky blood red tone. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex, John.
So not only would it look like it's covered in red, but there were comparisons made to Han Solo. Did you guys see that when he was frozen in carbonite?
Yes.
And his hands were kind of sticking out. There were comparisons made to that. I would prefer, King Charles and Han Solo. That makes a lot of sense to me. So as we talk about retail sales, we talk about different parts of the economy. Here's the top 0.00001%. And this comes from the New York Times. It's a wonderful article. It came out yesterday. It says, these butlers are neither Carson nor Hudson. Of course, Carson was the butler in Downton Abbey. So this is apparently the modern butler.
Okay.
They're known as executive butlers.
Nice.
They're usually still a man. It's no like old dude in trousers that stays in the background. He is fresh-faced, wears a lounge suit with a tie, and is by his employer's side, whether they're home or not. They're described as kind of a private maitre d', and they go on the yacht, they travel with them, they do all the things.
Boy, I could use one of these people. John, you know anybody?
I was gonna. Would you hire me, Paul?
Exactly.
No way.
But I mean,
Mr. Sweeney, what can I get you?
I mean, as reading this article, I mean, they kind of do everything for, again, a private maitre d', just anything you need doing.
Mm-hmm. They're going to do it.
Here's your guy or your person.
Don't we call these personal assistants?
But these are like, here's your Bellini, and here's the right amount of froth on your iced cappuccino blah blah latte. And apparently the seasoned butlers, like in the UK,
Yeah, what do these pay?
can make about $125,000 a year. But remember, your uniforms, and you're going on all these fancy places. You probably have health care. You get your 20 vacation days. Starting job salary is $50,000. But also, apparently there's a school for this, Paul and Tucker. International Butler Academy in the Netherlands.
In the Netherlands.
I just want to put it out there. I might be available for hire.
Exactly.
Go to the academy. Learn how to buttle
No,
things.
I know how to do all that stuff already. I don't
Do
need
you?
no
You know how to make an
second
espresso martini with a blindfold
Which
on?
fork do you use?
Because that's the
where
thing.
we'd have the problem.
Yeah, sure I do.
All right, much more coming up. Frank McCourt will be joining us. This.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, and you can just go over to YouTube and search Bloomberg Podcast. All right, we're going to bring up in just a moment a simulcast with Bloomberg Television. Frank McCourt Jr., he's a Product Liberty Action Network and McCourt Global Executive Chairman. He speaks with Bloomberg's technology anchors Ed Ludlow and Caroline Hyde. Alex, do you know what the conversation is going to be about?
TikTok. So apparently he's readying a U.S. TikTok bid. Remember, President Joe Biden is forcing TikTok's Chinese parent to sell the U.S. app or face a ban. Obviously, tons of lawsuits all over the place. Former U.S. Treasury Secretary Steve Mnuchin has also said that he's interested in the app. Eric Schmidt, former Google Chief Executive Officer, has also said he's considered a bid in the past. ByteDance has said they have no intention of selling the asset. Remember, McCourt sold the Dodgers for about $2 billion back in 2012. So he's used to doing the things that make money and that people like, and et cetera. And he's been trying to rebuild social media through an innovative initiative called Project Liberty.
Okay. All right, so it'll be an interesting discussion. TikTok, the key issue will be, is it for sale? I'm not sure. So let's go right now. Frank McCourt Jr., Project Liberty Action Network, sitting down with Ed Ludlow, Caroline Hyde of Bloomberg Technology to talk about a pending bid for the online site TikTok. Let's listen in right now.
And radio audiences worldwide to join the Project Liberty founder and McCourt Global Executive Chairman and billionaire Frank McCourt, who is building a consortium to bid for social media app TikTok's U.S. business. Frank, welcome to the show. And how much money do you actually have to be offering to TikTok?
Well, it's too early to know how much the TikTok is going to be sold for. Or if it's going to be sold. We happen to believe it will be sold, and we're betting on that. We don't have the information yet, though, on what exactly they're selling, or a peek at the financial statements. So we can't really tell what the price will be. But one thing that's important, Caroline, is we're not interested in the algorithm. So we're interested in actually an alternative web where people own and control their data, own and control their identity. So we're not interested in ByteDance's algorithm, which I think makes our bid particularly unique.
Frank, we will discuss later on, I think, the technology plan. That's important, given that the algorithm is essentially put on an export ban list by China. But I'd be grateful in the first instance just to go through some of the mechanics here, if that's okay. For example, have you spoken to TikTok or ByteDance? Have you spoken to the US government about this bid?
Yeah, we have not spoken to ByteDance or TikTok. We have spoken to a number of other actors in this and have been encouraged to move forward with this approach. Remember, this is putting forward an alternative vision for how the internet operates. You know, right now, whether it's TikTok rather, or our own U.S. platforms, our information, our data, our personhood actually is scraped from us, aggregated by these big platforms, and they apply algorithms to it. I think it's time, past time really, that we have an alternative version of the internet where we each own and control our identity, own and control our data, and we have all the benefits of the internet and the wonderful technology that's there connecting all of us, but we're in charge of us. So agency is returned to individuals. That's the technology we've been building over the last almost 5 years. I greenlit this project in December of 2019. So the tech works. We actually have a proof of concept. There's almost 1 million users now on this new protocol. So now it's time to scale it up and give people a real choice.
Frank, you mentioned other actors. I'm conscious that Sequoia and General Atlantic, for example, are US-based firms that sit on the cap table of ByteDance. Do you have their support in your bid?
It's too early, Ed, for me to make these statements. We've retained Guggenheim Securities as our advisor, along with Kirkland & Ellis as an advisor, to put together all the pieces of this bid. But let's be realistic. This is early in a process. It's still very noisy. We don't know exactly what ByteDance will be selling. They've filed a lawsuit recently, so they're fighting this. But I am confident that at the end of the day, they'll either have to sell or shut it down. And we don't want to see TikTok shut down. There's 170 million users enjoying TikTok. We want to see them continue to enjoy it. But again, we're not interested in the algorithm, which I think makes our bid very, very unique. And we can migrate these users over to a new version of the internet where the 170 million users actually participate in the value they create and are in charge of their data. Imagine a version of TikTok where the version is clicking on the terms of use of each of the 170 million users rather than the 170 million users clicking on the terms of use of one platform. I don't think this data should be in the control of any one person, one company, or a Chinese Communist Party. I think it's important that we shift our mindset now and shift the paradigm from the internet we've been living with, which is doing real harms, and it's undermining democracy, it's ripping society apart, and of course we're hearing more and more about the harms to children. Let's build a better version.
We are with Frank McCourt, of course, a Project Liberty founder, McCourt Global Executive Chairman, and across radio and TV, we're discussing your potential bid for TikTok, if indeed TikTok is to be sold, and that is a big if. But all of this sounds philanthropic. Do you not want any money back if you're going to be raising billions, putting billions of your own potentially on the line here?
Yeah, of course. I think it's interesting that it sounds philanthropic to you because I do think it does have the potential of being one of the biggest impact projects of our lifetime. But this has to have commercial components to it, to be realistic. I mean, this can't be some alternative internet that is, you know, better architected and healthier for people, but no one uses.
So will there be advertising? How will you make money back? Is it subscription-based?
Yeah, all of the above. Let's think of it this way. Once you unleash the power and the innovation and the invention of a data-sharing economy, we're going to see ideas and models that far exceed what we have today. Right now, all of this is tied up in just a few companies, just a few platforms. Let's unleash the innovation of everyone and unleash and have the value sharing proposition be a bit different. So of course there'll be commercial uses limited only by our imagination, and maybe there'll be some advertising models, maybe there'll be some subscription models, but it has to be highly commercial.
Frank, sorry to interrupt you. There's a recurring question. I think Caroline would back me up that I've been very consistent in asking it, which is there are 170 million US users of TikTok, and most of them quite like using it as it is. Is there anything you can tell me about the product plan or your engagement with the existing user base that would convince that 170 million that they'll want to continue using it whatever happens?
Yeah, of course. This is the key to the transaction, is for them to be excited about migrating to this new model of the internet, let's call it this, where they own and control their data and where they participate in the value. So the user experience has to be every bit as easy, polished, and fun as it is now. But wouldn't users be excited about actually being in charge and actually participating in the value? And so, yeah, this has to be seamless in terms of the user experience, but the underlying technology will be far, far better. The design of the technology, putting them in charge of themselves. So, of course, it needs to be done in a way, Ed, where the users are as excited or more excited about the new version. But remember, right now, there's a risk that it will be shut down. So we don't want to see it shut down. We want to see the 170 million users continue to be on a platform that our government is comfortable with, and that ByteDance, quite frankly, is comfortable in selling it.
Frank, we use words like consortium or even like coalition. There are a number of people who have raised their hand about doing something with TikTok's US assets. Steve Mnuchin, former Treasury Secretary, and Eric Schmidt, one of the Google founders, kind of top of mind. Have you spoken to them and proposed, for example, that you all just get together, bring your intellectual capital together in one bid?
No, I have not. And I do want to distinguish our bid from what at least I understand their bids to be about. We don't need Saudi money to do this bid, right? We're not talking about the same type of architecture where we just replace Chinese ownership with another ownership, and then we have continue to have a centralized, autocratic, surveillance-based technology where users' data is scraped and aggregated and so forth. This is not our version is not a top-down approach. Our version is empower the users, empower people, and make this a people's bid. Make this something where individuals have agency and choice and power returned to them. The harms that we're seeing with the internet, and this is not limited to TikTok, right? Our own platforms are built with the same model of scraping data and exploiting it. Isn't it time we have a better model? And I see this opportunity as it's a fantastic opportunity to take proven technology and scale it and give people a choice, an alternative.
Frank, you've got people who are at the forefront of that argument about the harms of social media. Jonathan Haidt being one of them with the anxious generation. It's all I see on social media at the moment. David Clark said Tim Berners-Lee, who helped create the World Wide Web. However, this sounds like you need crowdfunding, ultimately. If you don't need Saudi money, what money will you need when you get a price point?
I think there'll be a combination of private capital, public, what I'll call public capital, and people's capital. So
it will be crowdfunded?
Well, crowdfunding has an implication, right? I don't think we're necessarily raising money on the internet. So that's not what we're talking about. But look, we've brought in Guggenheim Securities to help organize how we raise money. This should be, the investors here should be should really reflect the broad coalition we're trying to create here about reclaiming the internet, right? And using this as an opportunity to do that. So I would imagine, in addition to private capital, there would be